to maintain convergence in a converged standard, and while we're having discussions that may be educational to our stakeholders in terms of how they might look at various issues within the standard, the words being the same, we would continue, I think, to expect converged thinking on the standard around the world, and so therefore it's helpful that we have the IASB to listen and certainly share any perspectives if they think we're headed a different way. So that will be useful as well. And with that, I'll turn it over to Cullen, who's going to couple of administrative items.
Good morning. We had just a couple of items we wanted to cover before we jump into the technical issues, administrative topics, as well as a brief update on standard setting. In terms of administrative items, we have two more TRG meetings scheduled for this year. One is on July 25th and one is on November 7th. Is included with your meeting materials were the summary of our discussion from the last TRG meeting, as well as a summary of all TRG submissions that we've received to date. In terms of the meeting summary, I apologize that was one of the last documents that we got to you, as opposed to normally it's one of the first. That is my fault, and we'll try to do better on that in the future. But as you're reflecting on the discussion, or the summary of the discussion, if there's things that are of concern to you, you can raise them to us at any time. There have been a few cases where folks have reached out to us on the minutes, and it seems like, at least in some cases, people are sort of hanging their hat or really hinging upon one phrase or one word that's included in the minutes, and the staff would encourage you all not to do that. We do our best to summarize the discussion that we have at these meetings, but ultimately those meeting summaries are not authoritative, and so if you think you get to a different answer by looking at the minutes versus looking at the authoritative standard, you should be using the standard, and also reach out to us and let us know about those circumstances. In terms of the summary of TRG issues, one thing of note on that list is that we are up to date. So as of this meeting, there will be no TRG submissions that we plan to discuss that we have not already. It's not to say we don't think there are more questions. We know there are. We work with many of you on a regular basis, a very regular basis. So we know there's more questions, but it is worth noting that the TRG has made good progress in keeping up to date with the questions that stakeholders have actually asked you to weigh in on. So with that, Kramer, do you want to give us a brief update on standard setting?
Yep. Thanks, Cullen. So the TRG has met 6 times since the issuance of the new revenue standard, with this being our 7th meeting. The majority of the implementation questions discussed at the meetings have been resolved at the meeting without any further action needed. However, standard setting has been required on a few of the issues. To date, the boards have discussed all of the topics that they had directed the staff to perform research on based on the TRG feedback. Since our last TRG meeting, the FASB issued its final updates to the principal versus agent guidance, as well as the guidance on identifying performance obligations and licenses. The FASB and IASB staffs worked together in drafting each board's respective updates to remain as converged as possible in the drafting, where the boards made the same decisions. Additionally, the FASB board redeliberated its proposed amendments on narrow scope improvements and practical expedience in February. The board affirmed its prior decisions and directed the staff to draft a final accounting standards update, which the staff expects to be issued in the second quarter. Finally, I'll provide an update on the technical corrections and improvements to Accounting Standards Update 2014-09. The staff discussed 8 technical corrections and improvements with the board at a board meeting in January. The staff is in the process of drafting this proposed update and expects this to be issued in the second quarter. That concludes the standard setting update from the FASB, and I'll now turn it over to Henry Reese for an update from the IASB.
Thank you, Kramer. Very little to add, but just to highlight that last week the ISB published the clarifications to IFRS 15. So that covers three main areas of clarifications to performance obligations, to the licensing guidance, and to the principal versus agents guidance as well. And perhaps just to note that we've updated the website, and we brought together an implementation page for revenue recognition, which just shows how we are continue to support the standard and pulls together all the resources that are currently available for our stakeholders, including links to TRG summaries and the like. So I think that's the main things to update, but thank you, Kramer.
And with that, I think we're on to the fun part of the agenda. We've got 5 issues today. We'll start with the first issue being the scoping consideration related to incentive fees such as carried interests, and I'll turn it over to Rob Moynihan to talk about that issue.
Thanks, Jim. So Memo 50 deals with arrangements where certain asset managers receive incentive-based capital allocations from investors in the funds they manage, which is commonly referred to as carried interest. Because Topic 606 gives a listing of scope exceptions and scopes out financial instruments and other contractual rights or obligations that fall within the scope of Topic 323, the equity method of accounting, questions have arisen about whether carried interest arrangements should be accounted for under the Topic 606 framework or elsewhere. Today, we understand that preparers are following EITF Topic D96, which says that these contracts can be treated as revenues and which allows 2 methods of recognition, Method 1 and Method 2, which are described further in Memo 50. The FASB and the IASB deliberated the topic of asset manager revenues in joint meetings on multiple occasions in 2012 and 2013, and had previously decided that asset managers' performance-based incentive fees should be subject to the constraint on variable consideration, similar to other contracts with customers that include variable consideration. Example 25 in the new revenue standard gives an example of how to apply Topic 606 to an asset management scenario. However, example 25 did not explicitly mention whether it applied to situations where performance fees is paid in the form of a capital allocation, such as carried interest. The staff performed outreach with asset managers and hosted a workshop in January 2016 about the scope of these carried interest arrangements. The views expressed to us in outreach about whether Topic 606 would result in useful financial reporting for asset managers were very diverse, and the views closely aligned with the methodology that the asset managers use today under D96. Method 1 preparers generally objected to View B in our staff paper, while Method 2 preparers generally objected to the Topic 606 scoping in View A. Despite the mixed views about whether financial reporting similar to Method 1 or Method 2 is most appropriate, many of the stakeholders with whom the staff spoke think that the FASB's and the IASB's intention is that asset managers are in the scope of Topic 606. Several stakeholders expressed concern to us about the impact that View B would have on the consolidation conclusions for the funds under management. The staff think those are reasonable concerns, that treating carried interest as a decision-maker fee under the new consolidation guidance in ASU 2015-2, while treating the same arrangement as a financial asset or equity interest for the purposes of evaluating the scope of Topic 606, produces some tension. Several stakeholders noted that treating carried interest as an equity interest under View B could lead to these performance fee arrangements being variable interests under the VIE model, which could lead to consolidation outcomes. The staff think that incentive-based capital allocation arrangements such as carried interest are in the scope of Topic 606. The staff placed weight on the fact that Example 25 in Topic 606 describes an asset manager arrangement, and the form of payment, cash versus equity-based, does not change the compensatory nature of the services provided, nor the conclusion in Example 25. Many contracts with customers include elements of a financial asset and are in the scope of Topic 606. For example, an entity that provides a consulting service in return for share options. The staff also think that View A is consistent with previous joint board decisions on the application of the new revenue model to asset management contracts. In addition, the staff notes that View A will result in a consistent treatment within the asset management industry. We think consistent treatment of these contracts is important to investors. The staff has performed outreach with investors and analysts about asset management financial reporting. These users were evenly split on whether they preferred a Method 1 or a Method 2 financial reporting outcome, although most thought that both data points provided useful information. However, investors consistently told the FASB that they would like all of the alternative asset managers to follow the same accounting when it comes to the recognition of performance-based fees. With that, I'll turn it over to the TRG for discussion.
Scott?
I guess I can go back a long time to when D96 was written because I wrote it. It wasn't solely directed at the asset management industry. There were several industries which we at the SEC staff had become aware of that had similar arrangements where there was a fee that depended upon performance over a full year or 2 years or 3 years or 5 years, and the amount you appeared to have earned in one period could be lost in the next if performance was poor. But asset managers were certainly amongst the group. And obviously we know topic D96 has Method 1, Method 2. At the time, we hadn't named them with those wonderful Method 1, Method 2 names, but there was 4, 5, 6 different treatments that we saw going on. So we sort of considered it a victory to get down to 2 from what there had been. And there were various people on the staff that thought Method 2 was the right answer or Method 1 was the right answer. We had differences of view amongst the staff, but nobody thought that it wasn't revenue. Nobody thought that this was a financial instrument that was governed by the equity method of accounting or anything else. That was not amongst the views that were being presented. So, I was surprised to see that, now the question is, are we in the scope of Topic 323? Well, that's a bit of a surprise. We missed that 20 years ago, and it had been missed for many years before that, apparently, because it was not amongst the views that were being considered. So we all thought it was revenue. There was no argument from the industry back then that it was revenue. It was just a question of which method to use to recognize it. And I can certainly understand, because I remember sitting in the room all those years ago with people debating whether Method 1 or Method 2 was a better treatment, more relevant, more reliable. I can certainly understand why some might think that recognizing it as you go rather than at the end better matches the economics. But so far as I can tell, the board's discussed it and reached an answer that generally is going to result in needing to wait until the end, as example 25 says. I think the publications from the big firms that have come out in the past couple years have generally all said the same thing. There are limited fact patterns in which you wouldn't have to wait until the end, but by and large, that's where it'll be. It seemed fairly settled and clear to me once I read the standard. So I'm a bit surprised to see that it's apparently still an issue.
Your comments are not dissimilar from, I think, the nature of the discussion that we had with members from the industry, and there were others from the staff and the board there as well, so correct me if I'm wrong. But I think the question really was coming down to more, do you disagree with the treatment under the constraint versus whether or not you really believe they're outside of the scope, including questions like, would you be arguing that they were outside of the scope if Method 2 was the permitted treatment? And I think people almost to a person acknowledge that if Method 2 was the permitted treatment, they would certainly be arguing that they're they're in scope. They describe them as fees today, not as ownership.
Right.
I think at least each of the members that were around that table, and there were half a dozen or more, call them fees. They're performance fees. They don't call them owned interest. Actually characterize the ownership as, in some cases, non-financial assets and follow a non-financial asset model. So at least I think that's a decent summary of that discussion.
And, the other thing, when you say, if method 2 was the answer, people might not be arguing that this was outside the scope. It seems to me that somebody must think that if it's not in the scope, then you get an accounting similar to method 2. I tried to think through it, and I can't get method 2 even if this thing is an equity investment, because it seems then it would be non-cash consideration, and you'd have to follow the non-cash consideration model, which it doesn't seem to get me to method 2, because I think it'd be recognized initially at its fair value like an option. So it doesn't seem like I'd get method 2 anyways.
Others? Brett, sorry.
Yeah, I think, Scott, I agree with your comments as it relates to cash settled incentive fees and the like. I guess the question that we struggled with was, in carried interest form. I mean, their gap is applied to the form, and in this case, if the form of the transaction is in fact equity and equity interest, arguably in part your uplift, if you will, relates to the underlying performance of the investments. And it is an equity holding. So I think the struggle we have is if you remove D96 and you sort of say, okay, now apply GAAP, which GAAP am I applying? I think D96 arguably gave two methods, but that's I think I totally agree with you as it relates to non-carried interest form when these structures don't involve a carried interest, but when they do, which I think is the scope question we're dealing with in this paper, is it really? And I think we certainly agree with the arguments in View A. I guess similarly, I think we could see support for a kind of a View B type conclusion, whether that's an application of equity method or what. It's certainly a fair value approach, more of a fair value approach to the question. So that's the sort of struggle we have, is in the absence of a D96 model. Where does that leave you?
So just to follow up on that a little bit, and we had part of that discussion with the managers as well, is whether or not economically they thought the arrangements were significantly different. That is a cash fee versus a carried interest. And I think the discussion, at least around that table by the asset managers, was that there are a few economic differences. One is the tax treatment. The other is the timing of payment. That is, cash-based fees tend to be used in correct me, folks, if I'm wrong, in shorter-term arrangements where there is more selling of underlying investments that enable the payment of cash, and carried interest tend to be used as compensation in arrangements that are longer in nature, so there isn't the distributable cash at any point in time. But I think sort of a discussion that really it would be a form-based sort of outcome, and I guess then one question I would have is, could you then avoid the accounting required by 606 in any situation in which you had variable consideration by simply dropping the form of that consideration into, say, an LLC, and as opposed to taking back a form of consideration that says, I'll pay you cash when certain things happen. I'll put a sales and usage-based royalty into a legal entity and take back a carried interest, and suddenly I'm outside of the scope of 606 with respect to variable consideration. I now fair value the rights that give me a pass-through of the same cash. And so it would be, I guess, an interesting, if we head down a path that says form matters, I guess be prepared for a lot of form.
Yeah, I think, part of this, if you look at, I'm told under for IFRS purposes that there's mixed practice, that some people do look at these as equity, and some look at them as effectively performance bonuses under a revenue framework. So that's sort of, I don't know whether that's because they're looking at D96 or whether they're just looking at the merits of the issue. But certainly, I'd be concerned if it was being abused. But if in fact the ownership is in it itself is the investment that's, changing value based on it's sort of different saying, okay, I provided, let's say, consulting services and you paid me in your shares. I wasn't involved in your share movement, right? It is what it is, and that's sort of one transaction. Whereas if in fact I'm sort of an owner of the business in the sense that I'm going to affect the how the business performs, and then my reward is in fact that ownership interest. It's a hybrid instrument in that case, and that's where I think if you say, well, let's look at the substance, I think that gets you to a view A answer. Right? Admittedly, I think if you say, well, okay, but the form is in fact equity, and what do I do in that case? And so.
Yeah, and I get that. I think, though, you could also take, for example, IP, and put the IP into a legal entity, and instead of taking back a cash payment, take back a carried interest in the legal entity that now carries the IP that you have licensed to a third party, and say, well, my payment is in the form of cash distributable through carried interests.
Right.
And I guess you would then present value all of the future carry and recognize revenue following a financial instrument model, and if form governed.
Well, but in fairness, the sales-based exception, if you will, the sales royalty exception is a form-driven answer too, and so that arbitrage can already exist.
Brian?
Yeah, I would share some of Brett's concerns when the form is equity, and with the articulation in the paper of UA, is that there is equity. And it's saying, well, ignore that, even though the scope of 606 says, well, if you're in the scope of 323, then follow it first. So the paper seems, well, even though you have something that's in the scope of 323, just ignore it and go with the substance. And that seems a little, I guess, to me, a little intellectually inconsistent with some of the other things that have been said at these TRG meetings, and that, for example, credit card fees. We go, well, there's specific GAAP guidance about how to account for credit card fees. In substance, they're with the customer. So why are we not overriding that guidance? I think there's a discussion ongoing with the board, and perhaps something that's going to be reflected later on insurance contracts. I mean, those are with customers. Why aren't we overriding that guidance? So to me, there is, whether we like it or not, I think there is some merit to saying, well, there is equity, and we should account for the equity, and then account for the residual under 606, whether we like it or not.
So I'm struggling a little bit with that there is equity. I guess you could argue in form, but many of you, including folks around this table, wrote to us in the context of a different project on consolidation, telling us that in form and in substance, these are compensation for services, and therefore should not be included within the evaluation of consolidation. So that because somebody doesn't actually have an ownership interest, that was the argument in the comment letters, these ought to be scoped out. They are fees for services from purposes of doing a consolidation analysis. And now it sounds like we're saying, in fact, no, these are legal ownership rights, and maybe ought to be then considered, for example, in consolidation. Because I think we're jumping to their equity method investments, and I'm not sure they are. Allison?
So this is an interesting scope question that we're talking about. Some of the other scoping questions that we've talked about as part of the TRG, and we have another one coming up later in today's agenda, have been around things that may not have been accounted for under a revenue model or under Topic 605 in the past, but we're reconsidering whether Topic 606 ought to apply. This situation seems to be the inverse of that, where we have arrangements that have historically been accounted for as revenue, and now we're debating whether they should be, in fact, outside of the scope of the revenue standard. It's a little bit of an interesting situation. because of that, I think that companies today are comfortable accounting for these arrangements as revenue. It's difficult to see how a pure VUB answer would be appropriate, meaning that you need to account for these as equity instruments and that you wouldn't be applying the revenue standard. That seems to be just such a holistic change when we have a new set of principles that are supposed to be applied to revenue type transactions. It just seems like a major shift to take something that was called revenue and no longer call it revenue. But with that being said, the questions that I am aware of that we've been focused on for companies thinking about the application of the standard under the revenue model is around interpreting the constraint. And so it's unfortunate that the conversation today is around the scoping issue and not so much around interpreting the application of the constraint. And is the guidance in example 25, is that absolute, meaning that you always have to in every situation interpret the constraint such that the resolution of the uncertainty never happens until the very end of the contract? Is that in fact the answer in every single case? I think that's the interpretive question that I'm aware of that a lot of people wish that we could be discussing. But since we are discussing scope today, I think that we certainly support View A. We acknowledge that there are questions around the equity, especially if D96 goes away. And so acknowledging that, if there were an option that was available for companies to account for instruments either as equity instruments or as revenue, I don't think that's something that we could oppose. I think it would be concerning if that option was something that required companies to apply judgment and potentially have different accounting for different arrangements. It would seem as though the only way to make View C operational would be if it was purely just an outright election, that if you have one of these hybrid instruments, you either account for it entirely as equity, be consistent for all of your contracts, or account for all of it as revenue and account for it that way.
It seems like as I thought about this issue and appreciating Scott your involvement in D96, as we apply D96 and as we apply the number of developments in the ownership models since D96 was issued 20 years ago, I think we do look very closely at the scope of guidance, whether it's topic 810 for consolidation or whether topic 323 or any of the other pieces of guidance. That is to say, in our evaluation, I think we frequently start with the fundamental question of what is it that we are accounting for. And we evaluate the characteristics in evaluating whether it's ownership, whether it's a contract with a customer, or whether it's unclear. And it seems like the scope paragraph in the revenue standard is consistent with that, consistent with directing one to think about what is it that we're accounting for. I would just make a few observations that I appreciate the interest in keeping it revenue to align the accounting between pure contracts and align the accounting where there's an allocation of net income that's been embedded in a capital account. I appreciate the interest in consistency there. I also appreciate the importance of figuring out what it is that you hold and whether there are characteristics that differ from a contract. I would note that in the partnership's financial statements that are also frequently filed with us, whether supplementally or directly, those are typically reflected, the allocations are reflected in the equity section. That is, they're reflected in ownership accounts. And so And so it seems to me that the FASB appropriately, presented a question about the scope. I think it is important to work through before getting to the important application questions. I think there are important application questions, and I think those application questions, are different but important whether you're in the scope of 606 and applying the variable constraint model, or whether you're in ownership and working through consolidation or working through topic 323. I would, again, just an observation, I think sometimes it's framed as ownership is method 2 and contract is method 1. If I heard correctly, Scott, your observation was that didn't hold consistently, and I agree with that. That is, it seems that 606 has developed a different framework for evaluating variable consideration with different judgments, and in the absence of D96, we would expect registrants to work through the model in reference to those new judgments. So, an exact method 1 or an exact method 2, I don't think would survive beyond D96. So it seems, from my perspective, while I certainly appreciate the arguments for View A, and I would anticipate that we would accept an application of 606. I think relative to the characteristics of ownership, if someone made the arguments around the nature of what they had, the ownership model, we would expect a full application of it, including the consolidation model or topic 323. But it does seem that there's a basis for following an ownership model as well, from my perspective.
Others? Tom?
The majority of the board in the discussions of this topic has always viewed this as a View A model. And I don't think that there's any ambiguity as to whether we thought it was in the model or not. I understand that there's been push in the industry because they don't like the method 1 versus method 2 conclusions, and that there's been pressure going on to be able to make that happen, that it could be method 1 or method 2. But as you said, neither of those are going to be what is applied. If you end up being in an equity interest, there needs to be an evaluation about consolidation. And I would suggest that the equity method accounting would not get you revenue or present it as revenue. It'd be presented something separately from that. I find it unfortunate that we're having this conversation because people don't like the answer. And that people that had involvement with the industry have been pushing to be able to get an answer that they feel comfortable with.
Others? Oh, Scott.
I started, maybe I'll finish, or maybe I'll annoy people and then there'll be more responses. I mean, over the years, every time the accounting for a carried interest has been discussed, it has been discussed and concluded, and judgment has been passed upon it as if it is a fee for services. Again, D96, form of the interest, was never thought to make a difference. Never came up. Wasn't a discussion because we all knew they were revenue. When FAS 159 came out, fair value option, the SEC staff very quickly, and I think very correctly, said don't be applying the fair value option to carried interest because it's a fee for services. And if you applied the fair value option, you'd be violating the fixed and determinable restriction. So don't be doing that. When it was addressed most recently in the consolidation project, the conclusion was, yeah, it's fee for services. So not a variable interest. You know, consistently, it's always been the case. I haven't been involved in any of these discussions recently that led to this issue, but I have trouble believing that the cause of the consternation now is anything other than what Tom said. That the answer is not what people would like it to be. And frankly, I can understand that. As I said, you know, when we did D96, I remember sitting in the rooms and the arguments in favor of why Method 2 made the most sense. They were compelling. Of course, then the Method 1 people would talk, and they were compelling. And that's why you had a staff announcement that gave both as choices. But again, I mean, the form, it was never considered important. And, you know, to Tom's point, I've thought through this since this paper came out. What happens if this is equity? Okay, well, then we have an arrangement where in exchange for services, we get non-cash consideration. That non-cash consideration being a right to an allocation of future earnings. That means that we value it at its fair value day one. And the entry is debit investment in equity security, credit contract liability, and then revenue gets recognized based on a straight line amortization of the contract liability, with the fluctuations in the value of the asset being, as Tom said, something other than revenue. Whether you record those fluctuations currently based on fair value or based on an equity method allocation where you now have a basis difference, so you have to amortize the basis difference, seems more trouble than it's worth.
Scott, I'm not even sure you get that accounting. You
Well,
own 100% of the fund on day one, and you simply sold rights to 80%, and you have no revenue for. It's just a retained interest in a fund that you go from consolidation to, if consolidation likely to continuing to consolidate.
Right.
And so you have no revenue accounting, you simply have a consolidated fund. But if you are in equity method, you likely just sold down an 80% interest or something like that. At least under our new guidance, if finalized, you would then fair value your retained interest, create basis difference. It will be.
Maybe you'd have no revenue.
But I more fundamentally agree with you. This issue never came up in terms of whether or not they were in the scope until the issue about could I get something potentially more desirable from an entity's standpoint than the constraint in the revenue standard. Wes?
I guess maybe just addressing a fair value point. If the suggestion is that we're fair valuing significant influence or control, I'm not sure that's the right framework. The underlying would be an allocation of earnings of the fund should it produce it. And so, I think that's an important application question, but I think it would be important to not be measuring the value of a block of shares or equivalent to a significant influence premium. I guess I would also note that that seems to be the result of applying the non-cash consideration, or fair value measurement seems to be the result of applying the revenue standard. So if that's a concern, I think that's a concern in the context of 606. in terms of, the question, I think it's an important question because when you look at the characteristics of the arrangement, by my evaluation, it has all of the characteristics, all of the rights of a financial asset. I think the question is, can you move past that and past the scope paragraph in 606 to nonetheless account for it as revenue? Appreciating that there's, at that point, a difference between the fund's financial statements and the fund manager's financial statements. Because I don't think anyone's debating whether the fund's financial statements should recharacterize that arrangement differently, at least not in this forum. And so to me, the question is an important one that arises out of an examination of the instrument rather than perhaps something broader, different from just a technical read.
So a couple questions. So I now, on the discussion, I better understand why there's a little confusion out there. I think Brett or Allison may have made it that today no one gave a second thought. You just put in revenue because of D96. And if D96 is removed, then a question occurs. So is D96 applied to all of GAAP or just public companies? Scott, I mean, you said you wrote it, so it was really just SEC registrants?
Yeah, I mean, certainly I wrote it when I was at the SEC. It was published by the SEC staff. It technically doesn't apply outside it. Now, that, to be fair, I have since written a book on revenue recognition, and I certainly acknowledge in that book that it is applied by private companies as well.
Right. I was just wondering, has anybody seen anyone not apply revenue to these arrangements? Because to be honest with you, I did not win what I thought was the better economic answer in this conclusion. I thought method 2 was the better answer, which was in essence to depict as revenue as you go. I lost the first vote, I lost the second vote, I think I even lost the fourth vote. But there was never a question in my mind that these were not within the scope of revenue. But I never really contemplated that there may be an argument that they're not. I just thought they were in the scope of revenue, and I just thought that I could eventually convince my board members to change their answer, and I have not been able to do that, and I'm not going to be able to do that. But I did think this was within the scope of revenue.
Yeah, and as I said, for 20 years and before that, because it wasn't a question when D96 came up, everybody assumed they were revenue.
But if you were to allow a view C, would companies want that? Would investors want that? If the appropriate conclusion was what Jim said, which I think is how these things operate, Hal would know better, but where you basically create the fund manager owns 100% at day one, and then you basically sell down to where you have a 20% interest, you would not have any revenue. You might have consolidations at the beginning and then a new basis event as you deconsolidate. Literally, if there was an option, would anybody take that option? Does anybody know?
At our outreach meeting, I think the participants were relatively unanimous that that's a form of accounting they were not interested in. What they wanted to do was keep method 2, which isn't on the table.
Can I just ask a fundamental question? Because if you go down that route, and people are referring to the fact that you would look to 810, but at the end of the day, in most instances, if the fund manager if there are no kick-out rights associated with the fund manager's control of the entity, wouldn't, in most situations, you consolidate these things? I mean, you're selling down to well below a 20% interest. And I just don't see how, under VIE land, you would not be consolidating these things. And I can't, at least at the meeting that we held in January, there was not a groundswell of support for that accounting answer.
Any other? Brett?
Just one other, maybe a nuance, but we were talking about non-cash consideration and variable consideration, and I'm just thinking back of the board's distinction around the form of the consideration not being part of the constraint, that's outside of the constraint versus the entity's performance. And I think that's some of the tension here, maybe a little bit around maybe it's back to the whole point about the form mattering, but I think that's, I'm not sure that if in fact we're talking about, again, the uplift in the value of the underlying shares, that is really, in the sense, not part of the form of the consideration. And so.
Not sure how to summarize this discussion other than one. I think in discussion within the FASB anyway, and the staff would know better because we did this in small group meetings, so I've only heard reports back. But I think the board, to a board member, but we're all here, so we can disagree, felt that in making their decisions, the intent was that these were in the scope. It came up on, I think as Russ said, 3 or 4 different occasions because of disagreement about Method 1 versus Method 2, but it was never really a discussion about are they in scope or out of scope. I think some clarification in the example actually tried to make it clearer that performance fees were in fact in the standard, that notwithstanding what I hear is others saying that perhaps form should govern. On the one hand, it seems clear to people listening at least what the board's intent was. I don't know what to say in terms of deviating from what the intended application of the standard by the board is. Obviously, Wes, you have some influence on that as well. But Tom?
Well, perhaps we ought to consider a technical correction to communicate our intent by changing the scope and excluding carried interest from the exclusion. We've excluded from the scope, so you can say 323 except for.
Or do a clarification that says, fees for performance are in including.
Jim, just a couple of comments just to add into the conversation for us to think about. I think there's a view potentially that you look at the form of the interest, and it might be an ownership interest, it might be an investment, and you go down the lines of whether or not it's a financial asset. When you look within GAAP in terms of the definition of a financial asset, it's a right to receive cash flows. It's a passive right to receive cash flows. And in that context, if you have to perform a service to get those cash flows, I don't know if it technically meets the definition of a financial asset. So I think we need to think about that as well.
I think the summary, Jim, is good in terms of maybe just in terms of the financial asset definition. I guess the piece I focus on, Matt, is there's a couple of, it's cash, ownership interests, or contractual rights that are settled in cash. And so it's that middle piece that I think creates creates sort of the debate. I think in terms of board intent versus the standard, it seems to me that the paragraph around scope and the example, could potentially be, evaluated. But absent that, I think there's the potential for a view that aligns the underlying fund treatment with the fund manager's treatment. And also room for a view that creates a difference and creates revenue at the fund manager level.
And to Matt's point, and I appreciated the definition of a financial asset is broader than just cash ownership interest, although one thing we might want to do is take a look at some of the comment letters from those in the industry on the consolidation project, perhaps some of their disclosures about whether or not there is really a belief that these are financial assets. Am I right? I haven't gone back prior to this meeting, but I did prior to the industry meeting, and I think some pretty compelling arguments made both in those comment letters as well as their filings today that would tell you these are not, in fact, from their view, financial assets. But that, again, that kind of feels, to Tom's point, the argument is shifting to get to a different outcome depending on what project we're in. Larry, then Mark.
I think a few things are worth noting. First of all, in terms of Russ's attempt to convince the rest of the board to see the error of our ways, I think there were other board members that were sympathetic to the arguments that View B gives perhaps better visibility to the economics of the transaction. The problem was the board did not know how to deal with the general view towards variable consideration, and we thought that effectively if we went along with Russ's view, that would unravel totally the variable consideration. So also, in terms of the meeting that we had in January, I think it's important to note that two fundamental things that came out of that meeting were, first of all, a view that all fund managers ought to be accounting for them in the same way. There was a real cry for consistency in treatment, regardless of whether it's View A or View B. And secondly, regardless of whether it's View A or View B, that the alternative presentation ought to be disclosed in the footnotes as well, so that the readers of the financial statements would have both. So to reiterate what I said before, there was no cry for consolidating these things or treating them as consolidated interests. So I just think that's worth noting for everybody that was not at that meeting.
Yeah, just to add another board member's perspective, I agree with everything Larry said. I always thought about this as the various times that we talked about it, the nature of not this particular one component of the contract, but the nature of the contract was fees for services. The industry's always portrayed this as fees for services. To Jim's point, when we were looking at changes to 810, they said, please don't think of these as anything other than fees for services. So it just seems to me that this was always fees for services. There was a fundamental question, as Larry pointed out, and there was differences of opinion as to how to account for asset manager carried interests. No question about it. My personal perspective was it seemed an industry-specific type of question, and there was no way to try to do something for this industry without having unintended consequences everywhere else in the model. I do think there is Allison brought up a good question about once you are in 606, the real question should be how to apply variable consideration. I personally don't think that you are ever in either method 1 or method 2 going forward, and I think Scott said this too. It's going to be something different from that. But the industry meeting that we had with a subset of the board, I thought was very interesting because, when there were no microphones projecting to the world, there wasn't really a question about were these in scope of revenue. It was really just how can we get to an accounting answer that mimics D96. And I thought that was really interesting, just that the industry itself wasn't trying to argue that these were anything other than fees for service. And I think that just gets you into the 606 model with all the with all the attributions that occurs, that happens as a result of that.
I'm intrigued by Larry's approach where you go down a view A approach, but then provide the disclosure, because from a very practical standpoint, that's what's going to happen in the industry. I think investors have gotten used to having both a method 1 and a method 2 out there. If we pick one, and like Russ, I don't believe that 606 represents the economics of these transactions right, but that is what the board voted for, the majority of the board voted for. I think we ought to stay with that, because that at least gets us down from, we went from 6 to 2, and now we can go from 2 to 1, get one methodology. But I don't think investors will stop there and just accept that. They will want the additional disclosure of an effective method 2. Whether we put it as a disclosure or not, it's not going to stop that information flowing. So, and I'm intrigued by all this discussion about consolidations, because when you did have consolidation of these types of entities in other circumstances, they were immediately deconsolidated as a supplemental disclosure, and that was what analysts used. So I'd be shocked if we went down that path, and that we're even contemplating it, because it's not useful information to investors.
Just so you'll know where all the board members stand. I've always felt that these arrangements were revenue fee-for-service arrangements, and that they should appropriately be within 606. So for me, the scoping question was never a big question. Early on, back, the first or so vote of the 3 or 4 that we had, there was a little bit of hesitation to me that I thought perhaps a method 2 type arrangement might provide more useful information. But I was quickly, struggling with that in light of what Larry said, which was that if you make sort of an exception in that case, then the variable consideration model sort of has the possibility of falling apart in a lot of areas. And so, to me, I think that, view A in this case was clearly, where I am, and I think that that's what the intent of the majority of the board was. I mean, perhaps some more explicit clarification of that, like Tom said, might help everybody. But I think in terms of whether it's in scope and what the intent was, not only from this board member, but from a majority of the board, that was pretty clear.
So I know we're running a little low. I mean, I'd be happy to clarify the scope and the technical corrections that we haven't completed. But if the group think that's helpful, we're happy to do that. I guess the broader question is, if we were to do that, does the group agree we should take on or consider improving the disclosure so that you have method 2? If we made it clear that these were in revenue and you basically have method 1, does the group think we should do to the disclosure for method 2?
Again, I go back to when we wrote D96. There was a consideration for whichever method you choose, disclose the other one. And there was certainly a consideration of putting that in. And I think what we said at the time was, no, we don't need to mandate the disclosure. If it's useful and important, then it'll come anyways. And, my sense is that if the answer is View A, and therefore the accounting is generally Method 1-ish. If investors want Method 2, it'll wind up being disclosed.
I think it's a good question. I think, Scott, you're likely right. My concern about heading down, if the industry figures it out, is what would be the scope for the disclosure. So you provide a disclosure of both constrained and unconstrained revenue, or would it be a targeted only in this industry? Is it required? Because if it is clear that it's in scope, I think what you're talking about is disclosing the constraint and then disclosing some form of unconstrained revenue. Brian, you still? Go ahead.
But I guess to
Consolidate
Mark's point, I
because of
thought
the
the answer was going to be you're neither really Method 1 nor Method 2.
I just turned the mic.
Potentially some other number. So now the number that's reflected in financial statements is neither Method 1 nor Method 2. Then there's going to be a requirement for disclosure of both what the answer would have been under Method 1 or Method 2. I don't know. I think it might be better that if a preparer thinks that it is meaningful information to an investor, there is a means to disclose it either in the financial statements or elsewhere in its filings.
Allison?
I would agree with what Scott and Brian said. I anticipate that a lot of the Method 2 companies today will likely end up disclosing it. It may be in the form of non-GAAP type disclosure, so outside of the footnotes I would anticipate. But I think that it will likely be driven by what those companies believe their financial statement users will be interested in, so that the disclosure will likely get out, and the concern about unintended consequences of having unconstrained variable consideration in the disclosure, I think there are potentially concerns for other industries if you were to head down that path.
Mark?
Yeah, I'm not going to add a lot. I listened to all this many times. We, like most people, thought that these were compensating for services, like Mark said, and others. But certainly if there's a path to explore, because we think the economics is, I think we're discussing here about disclosures, saying we have to disclose something that's to make the financials useful to the readers of the financial statements, because what we're providing them isn't useful. I think exploring what Wes is talking about, that some kind of an approach that for those situations where the information is not useful to the user of the financial statements, where longer-term funds or whatever it is, where we're expensing all the costs and deferring all the revenue to the very end, exploring something like that, we'd certainly be open to it. It has, as everyone's pointed out, a lot of hair on it that you'd have to, figure out how to deal with. But, I think we'd be open to something like that. But we always did think these were compensating for services, like everyone said. And just one other. We talk about, I think if I recall the discussion at the board meeting, I don't know whether they specifically talked about carry. The example, the standard talks about performance bonuses. It doesn't talk about carry. So I think to Russ's point, I'm not sure they specifically debated whether or not carried interest was in the scope or not.
And I understand the example doesn't talk about the form of the consideration in terms of how it will be paid, although it might be reasonable to conclude that the board had carried interest in mind, since the industry calls them performance fees or performance compensation. And so since the industry actually acknowledges that they're fees for performance, having an example that talks about the very fee in the scope is probably not too far a jump in terms of what the board intended. But I get the point of clarifying sort of form. Brian? Ian, did you have...
Yeah, Jim, just briefly, the consensus here seems to be we pretty much agree with what Tom and the other FASB members said. We think it is clearly within the scope, the group here do. We wouldn't see it necessary to add a clarification. We think it's pretty clear. And, as our general mode is not to fiddle with the standard where we don't have to. We'd have to think very carefully about making any extra disclosures at this stage before the standards even had a chance to bed down.
Thanks, Ian. I think we'll have to, think afterwards about sort of next steps, technical correction, or understanding what the consequences might be, and perhaps, figure out the vehicle to communicate with this group, whether that's a subsequent TRG meeting or just, follow up, discussion through the minutes or summary. But I think we've probably driven this as far as we can today, and on to another fun issue that I think we put the tough ones first today, thinking we'll get momentum as we go. The second issue is dealing with the intersection of class of customer and when do certain transactions sort of morph into a discussion of material rights. And I'll turn it over to Mark Barton.
Okay, thanks, Jim. Good morning, everyone. As Jim said, the next issue relates to how you consider the class of customer in evaluating whether a material right exists. Customer options to acquire additional goods or services exist in many industries, including but not limited to the retail, airlines, hospitality, and gaming industries. Topic 606 is clear that if a customer option provides a material right to a customer, the customer in effect pays the entity in advance for future goods or services. As a result, Topic 606 requires that an entity account for a material right as a separate performance obligation in a contract. Topic 606 also is clear that a customer option to acquire additional goods or services gives rise to a performance obligation only if the option provides a material right to the customer that it would not receive without entering into that contract. Determining whether a customer option gives rise to a material right is an area in Topic 606 that requires judgment in consideration of a number of factors, including whether, for example, a discount is incremental to the discount typically given to a particular class of customer. However, Topic 606 is clear that an option to acquire additional goods or services at a price that would reflect the standalone selling price for those goods or services does not provide a customer with a material right. Estimating standalone selling price, of course, also requires consideration of information about the class of customer. Stakeholders inform the staff that there are questions about how the class of customers should be considered when evaluating whether a customer option gives rise to a material right. The staff thinks it's important to first point out that the guidance in Topic 606 related to customer options is intended to help an entity distinguish between an option that a customer pays for as part of an existing contract and a marketing or promotional offer that, although made at the time of entering into that contract, is not part of the contract, but rather an effort by an entity to obtain future contracts with a customer. Said differently, the guidance in Topic 606 is intended to make clear that customer options that would exist independently of an existing contract with a customer do not constitute performance obligations in that contract. Considering an entity's class of customer is an important part of this evaluation. The staff paper on this topic is intended to illustrate several examples of how the staff thinks the evaluation of whether a material right exists should be performed and how the class of customer should be considered in that evaluation. In examples 1 and 2, the staff thinks the determination of whether a material right exists in the contract is clear. In examples 3 and 4, the staff thinks that significant judgment will be required to determine whether a material right exists. However, the framework the staff uses for evaluating whether a material right exists is the same throughout all examples. In each example, the staff tried to illustrate the underlying principle of the evaluation. That is, does the option in each contract exist independently of the existing contract? In making that evaluation, the staff tried to illustrate the class of customers considered by comparing, for example, the discount granted to the customer that is being evaluated with the discount typically granted to a customer in the same class that received a discount independent of a prior contract with the entity. The staff thinks it's important to point out that the examples in the memo are not intended to suggest that there's a one-size-fits-all approach to the types of arrangements illustrated by each example. For example, not all coupons given to customers represent material rights. Rather, the evaluation of whether a contract includes a material right is highly dependent on an entity's specific facts and circumstances. With that, I'll open the discussion up to the TRG members for their observations on the examples. As we discuss the examples that are more likely to draw different reactions from TRG members, it would be very helpful to the staff if TRG members could explain the basis or framework used in forming their views and how it would be applied across the other examples in the staff paper.
Brett.
Thanks. Yeah, I think there were elements in this paper that were helpful, and I think the notion, Mark, that you referred to in terms of which customer I'm comparing to is sensible. I think there was some confusion that some people thought I might be determining whether there's a material right by comparing, let's say, people in the same status to each other, which seemed like there'd never be a material right then in that case. But I think what we step back and, acknowledging that material rights is in fact new guidance in the revenue standard, one of the things that may be distinguished from current GAAP, right? Because we now have a model for loyalty points. As we think about this question, I think the issue is, do the rights accumulate based on prior purchases? And I think if you stipulate that they're material and they accumulate based on prior purchases, which I think is in fact the case with whether it's volume, some of these volume discount examples, or in fact the status questions, these rights accumulate based on prior purchases. Then to us at least the question is really then, okay, if I could get them for free, i.e. if they were available like a coupon, I could get the same thing without having made the prior purchases, then I understand why that wouldn't be a material right. But at least in our assessment of this issue, it's fairly intuitive in the sense that the rights that one gets are a function of contract. They're contractually provided. They're promised in whether it be on a website or whatever. It's a promise to a customer, and it's based on prior purchases. And now the question is, are they in fact, compared to what I could get for free, do these things have substance? Again, I'll stipulate that there's probably a category of them that would fall into the immaterial camp. Whether it be waiting in a special line to register early in the hotel, or something like a bottle of water in the hotel room. But many of the rights that are provided are in fact very material to customer transactions, and they accumulate based on prior purchases. So that's sort of that's the framework we would use to evaluate this question. And we found the comparison to other classes of customer to be confusing. So what would I mean by, for example, if you told me that I have a transaction with a customer where they buy the first 100 units for $1, and the next 100 for 90 cents, and the third 100 for 80 cents a unit, and I now want to compare that to another customer who has similar volumes but commits up front to buying the 300, if you will, or the 3 million, or whatever the number of units they commit to, they get the preferential pricing up front. Now, if I decide to compare, it seems like it clouds the analysis, because in fact the first customer, even though they were similar class, they were similar volume, they weren't willing to commit to the level of spend, and therefore their deal was they paid more for the first few units. So again, as we look at that, they decided to pay more for something, and it seems like it meets the definition of material right as long as it has substance. So and I think some of the words in the standard around this evaluation would be like, if typically you give it away. They use the word typically. So I think we found in the airline status issue, we found it difficult to understand how, I think our experience is many of the airlines either don't give away status, or maybe give it away on a match basis for a limited time. Some that we've spoken to said that they don't even track it because it's so infrequent. So for us at least, it wouldn't meet the threshold of being typical to get it for free in that analysis. And I think to the contrary, we've seen lots and lots of examples of airlines, in particular, selling status, selling boost points to get to different status, which seems to suggest that if they're selling it, that there's in fact perceived value and it's not being given away. It's sort of so there's a lot of sort of competing evidence in the marketplace that suggests that in fact they do have value. So.
Brian?
Yeah, I found the paper helpful, but I did want to maybe ask Mark if we we could talk a little bit about paragraph 46 in this paper, and I'm going to walk through a scenario, and I just want to make sure I understand. I think the staff is saying, and I'll do it by way of an example, and it'll be an ice cream example because I know people like that. So let's say I'm a large person, and there's an ice cream shop, and it has a loyalty program. And it is the only ice cream shop in the world that presently has this loyalty program. And under the loyalty program, if I buy, let's say, 30 single cones, then for the next year, I will now get double cones. I'll get, instead of a sugar cone, a waffle cone, and I'll also get free sprinkles. All these things they charge for separately. This is the only program in the world. So is the paper telling me that's a material right? Because it accumulates, right?
I think you'd have to assess whether or not you actually have an accumulating right, and so perhaps the next large person that walks into the ice cream store and asks for all of those additional goodies.
Okay, that's what I was going to get to. So if another large person comes in and they just say, hey, you're really big, you obviously eat a lot of ice cream, we'll just give you the double, the waffle cone, and the free sprinkles, then it would not be a material right because they'll offer it to any large person.
That's the thought process behind it. I mean, I think they would have to have an established practice of giving away those free goodies to say that you don't have a material right. It's not a one-off.
Okay. So let's take it to the next stage. Let's say another ice cream shop opens, and it goes, wow, that loyalty program really seems to get the large people to go to that ice cream shop. So we'll have a similar program. And my friend, he goes he gets his status, and now he goes, you know what, your ice cream shop's closer to my house, and obviously I'm a large person, so I don't like to get a lot of exercise. So I'd like to go to it. Goes in and says, you know what, I would like the status. They go, well, you know what, if you buy 5 ice cream cones this week, then we'll give you this status. What's that doing for me?
I think that would suggest that what you have is a right that accumulates with purchases.
Okay. That's helpful.
Now, I think there would be an argument to say that would call into question the value of that right if it requires some number of prior purchases. Maybe it doesn't require the 1 full year of purchases. Maybe it's something less than that, so that probably could have an impact on the value of the right. But I think that would be an indication that you do have an accumulating right.
But maybe to press on a little further, maybe if it was, all right, you're a large person, I can tell, from the ice cream stains on your shirt that you buy a lot of ice cream, buy 1 cone, and then we'll give you the status, and maybe we go, well, then that's,
Right. I mean, there's going to have to be a judgment made as to what the substance of that accumulation is.
Okay. That's helpful. Thanks.
And there also will be a judgment about what is material. So if you had a program that it accumulates, but you buy 2 and you get the 3rd free, that's one thing. If it's buy 100 and get the 101st free, that's a different thing. So even if it accumulates, it doesn't always mean it's material. There's a spectrum. You threw out the number 30. I don't know where that falls on the spectrum, but
right.
But the point is, I get Brett's point about if a right accumulates, at least in my view, that starts to set the bar for you have to be looking for whether you have a material right that you have to account for. It's accumulating. But just because it's accumulating doesn't mean it's material because of that scenario of, buy 2, get 1 free, or buy 100 and get the 101st free. And then the other thing is just because a company says that it's accumulating doesn't mean that it's really accumulating. Companies may have a marketing reasoning or an intent in mind to say, well, I'm going to tell you that if you do this and you do that and you do this, I'm going to give you something special next year. But the fact of the matter is they may do that anyway. So the fact that it accumulates, the fact that they say it accumulates doesn't mean that it's really substantive because they may give someone else that same thing without having made a prior purchase.
I think you also have to evaluate whether it's a right. For example, the customer comes in, they happen to eat a lot of ice cream, and you begin to give them the upgraded cone, you do it because they're a valuable customer. It's not a written program, but suddenly they realize every time after they've made a certain volume of purchases, they get a little more ice cream. And by the way, they treat all of their high-value customers in such a way that they get a little more ice cream. And whether or not that's a right or whether or not that's treatment of a particular class of customer. No different than how any organization might treat high-value customers.
Thanks.
Mark.
Yeah, thanks. I think we got to make sure that we're talking about the same thing here. We keep saying free, and I don't think we're talking about free. If I go to CVS, and I've told Mark this, and it says buy one shampoo, get one free, I think we all understand that I'm not getting that shampoo free, the second one. So if I go to a hotel, and I just recently went to Philadelphia with my wife, and my wife happened to have status at this hotel, and funny, she got it because she went to the hotel that she's now, her new client that she's in New Jersey that she's staying at all the time, and she was talking to the manager, and the manager realized that she's going to be there all the time for the next 5 years, and he gave it to her for free, I guess, so he gave it to her because she's now a class of customer that's going to be there. So we went, and our friends went too, and we both got a room for $200. And we got to go on the top floor with a nice view. I think that would have cost my friend $35. We got free water. We got a newspaper. We got 2 newspapers because my wife checked the box that she wants the Wall Street Journal and the USA Today. We got breakfast, and we got all kinds of, we got to stand in a special line. And at the end of the night, the next night, we went, and our friends joined us for breakfast. I don't know whether they bought a newspaper or not on their room. I don't know whether they got water, but at the end they had to pay more than $200. They paid $240, I think, and we paid $200. So that's a $40 in my mind discount or off list or whatever it is. I don't by any means think that I got a free breakfast. I paid $200, and so if you allocate it under the standard, something would get allocated to that free breakfast and that free water and that free newspaper and that free upgrade. So I think we got to make sure we're not dealing with buy 30 ice cream cones and you get the next one free. It's buy 30 ice cream cones and you get a discount off the next one. And then when we look at that discount, I think the standard's pretty clear that we look at the class of customer and evaluate whether that discount is incremental to what we would give to that class of customer. And it even says in the next paragraph that the option does not provide the customer with material rate, even if the option can only be exercised by entering into a previous contract. So I think what we have to do is take that price that I paid for my hotel room and what my friend paid for his hotel room. We both got basically the same thing. He didn't get a better room, but he would have paid for it if he did. And say, is that price standalone selling price for that class of customer? I think a big proponent of this is if I'm still making a reasonable margin on that hotel stay, isn't that what the standard is sort of telling us to do? We have to look at the standalone selling price for that class of customer. Cost plus a reasonable margin seems to be appropriate for standalone selling price elsewhere. But we're saying it's not okay here. So if I get an ice cream cone, in Brian's example, the sprinkles cost 25 cents extra. Well, I didn't get free sprinkles because they're inseparable from the actual ice cream that I got. We wouldn't say that those are distinct performance obligations. I can't just walk into any hotel room and say, I want, a free upgrade, without actually buying a room. I can't go and say, just hand me a newspaper. I can't go, those are inseparable from the actual stay. So I think we got to make sure that we know we're not dealing with free things and look at the standalone selling price compared to that class of customer to make sure that we are actually doing what the standard says and saying, is that standalone selling price for that class of customer? And I agree with looking at all the other things. I look at this, what you said in here, you say, would you provide it and could you? I think we got to make it clear, do they provide status like my wife got for not having the prior purchases? She actually stayed at this hotel prior to that, so maybe that excludes her. How do we apply that judgment? And do we have to actually have concrete evidence like Brett was saying of, how tangible does the evidence have to be that we've given it to other people for free. I personally don't think that's absolutely necessary under the standard, but if that's what we're saying, how frequently do you have to do that in order to say that this is a class of customer? But I think a big proponent of that's going to be, am I selling this for free or below cost? Am I losing money on the next purchase? I can guarantee you that they're not losing money every time my wife now stays at that hotel. They're still making money on it. They're making cost plus probably a pretty good margin on it. And that seems like standalone selling price to me. But, if we're saying that that's a material right, then I think it's, we got to start saying that actually when we stayed there and paid our $200, we prepaid for the next water that we're going to get and the next newspaper and the next, whatever it is. So I think we got to be careful of saying all these things are material rights. I completely agree that if it's buy 10, get one free, that sounds like a pretty, 10% material right. Is it material or not, like Colin was saying? But when we say buy 10 and you get 10% off your next purchase because you're a high volume customer, I don't know, example 3, I can go back and forth, but if it's a volume discount, we always thought that you estimate those volume discounts because everyone else has to get that volume first. But I guess there can be an argument that it's class of customer, that one's judgment. But I think when we're just talking about discounts off the next purchase, which is that's what they are, we can't start just saying all those are material rights.
Allison?
So the struggle that I think I've been hearing on this issue is, again, where do you draw the line between something that's a material right versus something that's a marketing offer? And what struck me about this paper as I was reading through it is that I think that it tries to better distinguish what truly are marketing and promotional offers, and that if you don't have a marketing and promotional offer, then you are almost by default then a material right because you're either one or the other. Within some industries, we talked about the travel industry, I think that people view the programs that they put in place as having marketing characteristics. The reasons why they put the programs in place are to incentivize the next purchase. Because they're trying to incentivize the purchase, the way that they develop those programs, oftentimes there is a categorization or a classification of customers in order to develop that marketing program. And so I think for some within the industry, especially if we're talking about the airline industry, because they're developing these for a marketing purpose, that's what has led to a view or down a view that these are not material rights. If, as a result of kind of reflecting on this paper, it makes it clear that you really do have to put a pretty significant weight on whether there is a prior transaction that has led to someone's ability to get the next purchase. And then the extent to which that prior purchase, how significant do you weight that, I think is going to be a matter of judgment and going to be very difficult, I think, for companies to figure out. There are some programs, I think, where they do grant status regardless of whether you have made prior purchases or not, and then there's others where you don't. So I think even within the same industry, you could very well have some programs that feel very similar, but just because of their business practice, whether stated explicitly or not, you're going to get to different answers. So the question, I think, coming out of this discussion is going to be around what level of consistency is going to be expected within this industry, what judgments will be accepted. That's where I think that the debate probably will need to shift from this point forward.
Russell?
Yeah, I agree with Allison. And maybe it's just that I haven't put as much thought into it, but I've never thought these are kind of loyalty programs, and I'm thinking of the airline programs in particular. I think the status is more about establishing a relationship with the customer, and the relationship is more about what you're going to buy in the future versus what you've bought in the past. And I think trying to make a distinction between, okay, well, what part of this is a material right because of what they've purchased in the past versus how much they're expecting to get in the future because it's a marketing offer is going to really be splitting hairs and difficult to do. I'll give you an example. I noticed over the last couple of years that Delta, which is the program that I honor the most, is now tracking not only how much I've flown with the airline, but they're also tracking my spending on their credit card. So are they trying to figure out what kind of class of customer I am based on how much I spend, just generally, or is it that they're trying to see how much I fly? And so, again, I think it's about establishing a relationship with me to ensure that I fly in the future. So I think of it more as a marketing offer. I think so in that example, are you going to say how are you going to determine whether that's a marketing offer or a material right? I think it's going to be a tough one. Scott?
And as Allison was discussing, I mean, these plans are put together generally by marketing people. They're all marketing offers. That doesn't mean that they don't affect revenue. I mean, if a store has a sale, it's a marketing offer. But we're not going to let them recognize revenue for the regular price and marketing expense for the difference between that and the sale price, right? It's some marketing offers accomplish their goal by reducing revenue. Others accomplish their goal by giving you more stuff. Others accomplish their goal by giving everybody more stuff. And I think what we're trying to figure out when we think about material rights is this an offer that gives everybody cheaper prices or more stuff? Or is this an offer that only gives people who have made purchases in the past cheaper prices or more stuff? If it's the latter, then those past transactions implicitly, under the standard, included some form of prepayment for the future goods or for the future discounts. I think that the concept is fairly easy. There are judgments that would go into applying it, no question, and we're not going to bother to account for little things. But you know, reading this, I thought that the concept was clear. The application could be very difficult because these programs, in some cases, as I understand it, are very complicated to run. And complicated programs get complicated judgments and possibly complicated accounting. That kind of flows. But I didn't think in concept the question was very difficult. And I don't think whether you're selling the future product as a loss, at a loss is the line. You know, the line is whether you're selling it at an amount that would be available to others or not. And if you're not, if you're selling it less because of past purchases, you know, to me, I think that that the standard makes that clear that that is a right, and we've got to evaluate whether it's material.
So, I agree in terms of the concept being maybe not as hard to understand as the application. I do think, just personally, it's hard to figure out whether something is that's notionally based upon the past is an entity's mechanism for determining whether you are a high-value class of customer, and therefore that entitles you to the high-volume class of customer pricing or not. For example, a professional services firm may be able to negotiate with a hotel chain that when you stay at that hotel chain, they will provide you with complimentary access to the Wi-Fi system and not bill you separately. Obviously, at that point, to me, embedded in the exchange price that you've entered into. On the other, and that same chain may have a program that says you as an individual, you don't demonstrate the same purchasing characteristics as a global professional services firm. But boy, if you stay here a lot, I want to encourage that, and I might give you that same opportunity going forward. But the way I measure whether you're valuable to me, because I don't see the purchasing volume of 100,000 employees worldwide, is I want some mechanism to track your prior purchases and figuring out whether that is a right that accumulates solely based upon prior purchases, or is that something they would offer to anyone, including, I guess, in sort of Mark's example, let's say his wife had never stayed at the chain, but she goes in and says, I'm going to be staying in town for the next 5 years. I'll stay at your chain if I get complimentary Wi-Fi access. And that's where I think it becomes difficult. Right.
Yeah, just a few incremental thoughts, hopefully. First of all, I think Scott's point on marketing is spot on. I mean, loyalty points are, we talk about loyalty points, we assume they're going to be accounted for under the revenue standard. I think they are marketing. Frankly, I think the objective, the economic objective of these status programs is very similar, to a loyalty program. It's a different way of quantifying how you accumulate the rights and how you redeem the rights. It's as opposed to being sort of limited by number of points that you have to redeem to achieve goodies. In this case, it's limited by, you have a year to achieve certain rights. And some of these status programs are as simple as, you stay in my hotel a certain number of times, and in the next year, if you achieve that status, you get 3 free hotel stays. So it feels very much like a loyalty program, and it has those kinds of designs. It's also, contractual. It's not like, Jim, when you were describing of this is a practice that you come in and I treat you a certain way. These are promises that are provided. If you read, for example, some of the airlines, websites, they'll say things like, the more you fly, the more goodies you get, the more, and I think it's a contractual promise in a revenue arrangement. So I think, distinguish from maybe a practice that might develop over time, or a promise in the future. Hey, if you come and shop in my store, I'll give you these things. I'll treat you really well in the future. This is stipulated ahead of time as you fly a number of times, or you rent cars a number of times, and you get these awards. So for us, at least, that was a consequential distinction, I guess. The other thing is the CX 606 says that a material right is a good, service, or a discount on goods or services. So it's not a question of, well, I have to buy something else. If I buy something else, if I get a first-class ticket for the price of a coach ticket, that's a valuable right, and that is just, you could say that's just a discount on I still have to buy a ticket, it's just a discount. But again, it's the same kinds of things you may get with your loyalty, with your points programs. So I don't know how to distinguish the two. I think they feel like, economic parallels. And frankly, I think all the reference to the free bottle of water and it just confuses the analysis. These are, let's just stipulate, these can accumulate to be material amounts of money. The airlines are actively managing these programs. There are websites where you can see what how they value the status is and again they sell the status to people who haven't achieved the right number of purchases. So I would ask the question of people who think this is a classic customer analysis, how would you account for the payment that the entity got for selling status? Should they record the revenue immediately, since in fact there's nothing to it? These are just rights that you get by virtue of being in that class. Or do you think that no, when you sell status, in fact you provided a promise to provide certain things to the customer in the future that in fact are the same kinds of things you're going to get under your status program if you achieve that by virtue of making purchases. So
I understand that it's valuable to be a high-value customer. I also think it's valuable to have the purchasing power of, say, a Fortune 500 company that may be actually able to negotiate much more favorable pricing than you as an individual that doesn't have that same purchasing volume. In fact, I might pay a lot up front to be able to have that. So I think that's no different than somebody saying, I want to have the rights of a high-value customer but not have entered into the transactions or the purchase volume to have it. Doesn't surprise me that somebody says, well, if you want the rights of one of our most valuable customers, you may need to pay something for that. So that it doesn't mean it's not a factor I wouldn't consider, but it to me wouldn't be determinative of somebody who's never done volume with you wanting the rights of a high-value customer, having to do something for that. And I would also question whether it's clear that they're all contractual, even when there is a spelled-out program. For example, if you go to the hotel and the line happens to have non-high-value customers in there, whether they kick those people out of that line, or if that line happens to be closed, whether you have an enforceable right for them to open up a high-volume line to check you in, or whether or not the breakfast is unavailable, whether you have an enforceable right to receive the breakfast or an enforceable right to a newspaper. Now, again, not that their programs aren't spelled out, but I think many of them talk about things that generally occur, but whether or not you have a right to those is maybe less clear.
Yeah. Well, and I think just maybe one further aspect of this, which is I think in some respects, making those distinctions, I do believe that looking at the sort of inconsequential things in the analysis clouds it, because I think it's important to focus on where it's material, and again, frankly, I think trying to make a distinction between, well, these things are not material, so. But at the end of the day, we made promises to a customer. They're made based on prior purchases, in effect. And in a way, it's easier if you sort of say, well, look, there's got to be practical ways to approach this issue that because if in fact, trying to distinguish, trying to make judgments around when it is and when it isn't, to me, can lead to some more difficulties and challenges. For example, if I concluded that as I give it away enough times, say it's 10% of the time, or that in that case it's not a deferral item, and then all of a sudden I decide, it's better for my business if I stop giving it away, and now I drop below some 5%, some time where and I say I now have to account for this as a material right. What do I have to switch accounting now and record a loss for, even though I've effectively made that decision based on it being a better economic. It just seems like it's almost, if you stick with the concept here, it's pretty clear, and that's where we would stop.
Mark? Yeah, I just want to make sure it's clear. We're talking about incremental discounts, not free. I think in Brett's example where you hit status, you get 3 free hotel stays without paying for anything else. That's clearly a material right. We understand that. I think everyone understands that. And then to Scott's point, that is, he's right. You evaluate the discount. That's what the standard says. You don't evaluate it on the discount that you give to everyone. The standard's crystal clear. It says, and you stopped, Brett, when you were talking about this, a range of discounts typically given to those goods or services. Then it goes on to say to that class of customer in that geographic area or market. Then the next paragraph again says, you look at the standalone selling price for that good or service for the discount. Am I discounting it below the standalone selling price, even if the option can only be exercised by entering into a previous contract? So if we're going to say that we're looking at the list price or I know the standard clearly says that contract price is not necessarily standalone selling price. List price, in this case, is not standalone selling price. We need to determine what the standalone selling price is for that customer and then evaluate, like Scott said, the discount off of that standalone selling price for that class of customers. So I just want to make sure we're looking at this. I mean, if the board didn't intend to evaluate this on the class of customer, then that needs to be changed. And if they didn't, if they said if there's ever a transaction prior to this, that you disregard this and it's automatically a material right, then we need to change paragraph 5543. But you got to look at the class of customer. It's not the discount that everyone would get that walks in the street. It's, what discount would you give to someone with this volume? What discount would you give to anyone? Now, the paper goes through and says, have you ever given it to someone straight out? I mean, if that's critical, then the minutes should reflect that that's what you want to see, that you've actually, like Jim said, you've given it to someone else that came in and said, it looks like this person's going to be high volume. You've actually given it to them, and then we got to talk about how frequent that has to happen. But I think the evaluation is pretty clear what you do, and we need to make sure we're not talking about free, distinct goods and services, because clearly I think everyone agrees those would be material rights.
We're talking about evaluating an option that was given to a customer with a prior purchase and trying to evaluate whether we ought to account for that option because it is a material right. You're right, it does refer to, look at the amount that that class of customer would pay. I believe it is axiomatic that you cannot then define class of customer by prior purchases. Otherwise, you've created a do loop that you cannot possibly get out of. So, yeah, we do have to consider class of customer, and it's certainly the case that there are lots of ways to designate and stratify classes of customers, and we do have to make sure that we're comparing the discount being offered to this customer to discounts that would be available to others in the same class that have not made prior purchases. I mean, if you can define class by the amount of prior purchases, then we wrote guidance that can't be applied.
Well, it can. It would just never be a material right.
Okay, well, so we could just delete it and that'd be simplification. Yay! I think it's absolutely correct. We can't possibly be. We can't eliminate the consideration of class of customer, and we do, when talking about it, sometimes not say those words when we're kind of shorthand describing the situation. But I think it has to be clear that when we talk about class of customer, it is a class of customer that is not delineated based on past purchases.
And that's why I think it gets challenging, because you may likewise meet that class that is the class they would offer it to because of the volume of travel, and I get the do loop, but recently got status on United. I didn't fly them at all in the last 2 or 3 years because of my purchase volume at a hotel chain. So presumably they must have looked and said that is someone that would be nice to give this status to as a class of customer. I don't know if that's an inducement, but odd that someone who actually had purchase volume with them that was a valuable class, it would say there, every time they fly, they're pre-purchasing an upgrade or a stand in a different line for next year, but somebody with the same purchasing activity at a hotel chain isn't, because they're a different class of customer, and whether or not that person who's traveling likewise is that class of customer, I think is more difficult to figure out. Russell.
I was going to make a similar point. We shouldn't be penalizing these companies because the only information that they have about identifying classes of customer is the information that they have access to about how often their customers use their. It may not be that it's based on past transactions necessarily. It's just their way to measure class of customer. I guarantee you, American Express values Crowley a lot more than me, and they're basing that analysis on how much they think he's going to spend in the future, but based on how much he spends in the past. But they're really looking at the future. So I think it's going to be hard to cut this, into. I get it if it's accumulating right, that we all understand that, but the status, I think, is a more difficult question, and I think it's mostly about trying to identify the class of customer, and it's not necessarily rewarding them for past transactions.
Mark?
So a question, recognizing that this could happen in every industry, and ice cream included, and Lord knows I've sought out loyalty programs for ice cream. But is 80% of the problem or the 80% of the implementation issue in the travel industry? I'm just trying to think of possible paths forward for us. Is really that's going to be where the issue is for us to sort of think about and focus on? I mean, I do understand that it could be everywhere, but just trying to narrow down.
I guess before we go to this being an issue, I mean, I haven't heard a lot of disagreement with how one should think about the standard. I haven't heard too many people say Mark's paper didn't make sense. So are we more or less sure there's maybe certain things we wrote that you didn't love, but more or less are we on the same page with this is how you apply the standard, and now it's a question of can the system apply judgment to account for those arrangements or not?
I'm not clear that we're all on the same page, because I hear some arguing that if it's just, as long as it's an accumulating right, that you're done, the accounting analysis is over. I certainly take Scott's point about the fact that the nature of the prior purchases that an entity makes sort of infers that perhaps there is a material right. I get all of that. Where I worry, and this is even going to Mark's point a little bit further, going back to just volume purchase examples, does that mean that every volume purchase program out there is, in fact, have embedded material rights? I think that may be surprising to some industries. I think it's also interesting, just even within the standard itself, example 24 is a volume discount incentive example. There's no explicit discussion of class of customer or anything, but it's interesting that the conclusion there, that there is no analysis of material right. It's almost as if perhaps it was inferred by the board that there wouldn't be one in that scenario, that you account for that that incentive, this variable consideration. So I think there's some that would think about volume purchases. They would look to example 24. They would look to the guidance on material rights, try to put all of that together and think that there is an argument for class of customer in certain circumstances. And I actually would argue that the paper that Mark Barton put together, example 3, I think leaves the room for judgment to apply class of customer in certain scenarios. But I'm not sure that I'm hearing that same viewpoint from everybody around the table.
So maybe if we could focus on the couple things that you all think you're not in agreement on. So you mentioned there are some that have a view of if the right accumulates, you automatically have a material right. I think the staff's view to that is no, you don't automatically have a material right.
And the other
First
one
have to assess whether it's material, and you also have to assess whether it's actually substantive or not. It seems like we all love to tell our stories about I got this free or my wife got this free. I mean, I'm sure every fact and circumstance is going to vary one to the next, and those are some things you'd have to think about to evaluate. Is it actually substantive or not that it accumulates?
So I think it's that question, and I think it's also what role, if at all, does class of customer play into the analysis?
One thing that I think Mark's paper did really well is it explains, at least to me, that class of customer is a relevant assessment, but you can't get yourself into the do loop, as Scott Taub would say, where you're comparing this transaction to the exact same transaction that someone else made. Do you want to talk a little more about that, Mark?
Yeah, I guess just a couple of things. As I'm hearing some of the discussion, I think I'd just be careful to start referring to something as an accumulating right, because I think the whole basis of the evaluation or the whole purpose of the evaluation that we're trying to do is to determine whether or not what you have is a right that would accumulate over time. So if you get past that point where you'd say, yes, what I'm granting you is a right as part of this contract, it's not a promotional offer, then you can start to think about, okay, does that right accumulate over time? And what is that right material? So I wouldn't necessarily always just jump to, something being an accumulating right, because that is the evaluation that we're trying to do. And then regarding the do loop, yeah, I think, at least from the staff standpoint, if the purpose of this is trying to demonstrate that a right that you're giving a customer is independent of an existing contract, it would not be appropriate to use as a basis for comparison a customer who has earned that right through a history of prior purchases. So that thought process is what we were trying to demonstrate throughout the examples in the paper.
Are there other specific points where we think we're not in agreement with how the model works?
Brett? I guess maybe I'll ask the question directly, and that is if as suggested in the paper, in the issue around status, the idea would be to say, well, this particular airline will, let's say, match status for a comparable flyer from another airline who comes and maybe they'll give it, as I understand it, will be like a 90-day trial period, make sure they, in fact, but all the time that somebody comes with the requisite level of prior spend, they give that match. It turns out that it only might be about, if the total population of people who earn status benefits, it might be a small percentage in total of those people. But every time they get it, if that's the analysis that says, well, okay, in that case, it's not a material right because they could have come from another airline and gotten it awarded to them. If that's where the paper takes you, then I guess I would say we probably don't agree. We don't agree with that. I think, If on the other hand, the view is, look, in order to meet that threshold of being a benchmark that would suggest that it's not a material right, you have to typically give it away, which would be at least 50% or north. Then I think we do agree. But I think so. I think it's clouded in our mind because the paper seems to suggest that, well, maybe it's okay to make that judgment if there are in fact occasions of quote giving it away or matching. So I think that's part of the challenge for us too is that if you look at loyalty points, again, there are occasions where loyalty points are given away as well. I might enter into a relationship with a retailer and they give me loyalty points up front. Now those, I don't think in fact that's part of a revenue arrangement if there's not yet a revenue contract. So how entities are going to account for that those points is a little bit unclear in my mind, but I don't think necessarily that would be a deferral because there's no revenue to defer yet. And yet then that same retailer might enter into an arrangement where the more you spend, the more points you earn, and they'll be accounting for loyalty points under the revenue standard in that analysis. So only point being that there could be situations where I give away status and there's no immediate accounting for that giveaway, nothing to defer, but nevertheless, for other customers who have dutifully earned their status benefits through prior flights, prior purchases, in fact, I'm going to defer revenue. So
we weren't intending for this paper in particular. We were not intending, for example, for it to be a kind of get out of jail free, if you want. We were attempting to have it be a balanced assessment of you need to consider the facts and circumstances. The staff thinks you would consider whether you frequently match or not. But, Mark also had a notion in there of, you have to consider how frequently you do that. So the fact that you match 1 in a million doesn't mean you automatically have nothing to do. You then have to consider, is it 1 in a million, or is it actually very frequent, or is it somewhere in between?
But imagine I match all the time, though. Here's the question. So I match all the time, but it turns out that's only about 2 to 5% of the total population of people who fly.
So I think you have to think about how frequently people actually change their purchasing activity. So how often is it that you're going to be a high value or high volume customer in that status with one airline and then say, next week I'm going to change to another airline and next week to another, because suddenly you're not going to have the status. What you're doing is shopping price, not purchasing volume. And so I think that may actually be indicative of when they match and why they have trial periods, is saying, look, I'll give you up front that status if you commit to being a high volume customer. But you actually have to prove that. You can't then next week want to fly on brand C and make the same assertion to them and say, each one of those, I am a class of customer that flies with you relatively exclusively. So to me, it typically wouldn't be, it might be industry based, but I don't know why typically would be 50% of the people in the program versus any time someone comes in and demonstrates, or reasonably any time demonstrates that they have that future estimated purchasing activity, they would be willing to give them that same class of customer treatment. And maybe that happens 5% of the time because that's the number of customers that actually come in and say, I want to bring this volume of purchase activity.
So two responses, Jim. One is the whole point of these programs, as I understand them, is to maintain loyalty, right? So it's designed to keep you coming back to the same airline. So, but again, my question to you though would be, if in fact it turns out to be 2 to 5%, that they will match it, does that suggest that the rest of the people, the 95%, in fact, is not a material right? And I
it would to me, yes.
So I don't.
I'm sorry. Go ahead, Dan.
I just wanted to make a quick comment about class of customer and just say that in my mind, we purposely put that language in there to sort of serve as a governor on otherwise identifying material rights sort of run amok. I mean, it seems to me that this discussion is a little bit like what we talked about with performance obligations, where people were finding performance obligations everywhere, right? With 1-800 helplines, whatever. And I think that we included class of customer as a little bit of to put a guardrail around that. I appreciate the do loop discussion, but I don't think that concerns about that should cause us to throw the concept out the window, and now all of a sudden everything's potentially a material right.
I agree, Daryl. And the do loop, I would just say, I guess, I don't think that's suggesting that people can't change classes over time just because I had purchases in the past. I mean, customers change class all the time. It's like, wait, I just figured out, I go to a restaurant, wow, this person's come in 4 times. They're a different class of customer. I'm going to start giving them free desserts and stuff. I mean, yeah, it's based on my past things, but in their mind, they just realize that I'm a different class of customer. All the stuff that Jim, you and Brett went back and forth on, I think that's the thing that we're very unclear on in the paper that's written up. And there's a lot of, I've said this before, it's great to say let's use facts and circumstances and judgment, but we have to have some fences around what that means. And, obviously we would have different views on this, and that would create diversity out there. So I think we need to, at least in the minutes or somehow hammer out what are the factors that we consider when we're making this evaluation. The AICPA, and Jim's well aware of this, has a paper out there that the airlines put together that I thought was well written and set and put it in this way. Here's some characteristics to consider as you go through it. I thought that was a good paper, but I'm not abundantly clear on which facts and which circumstances lead me down this accounting versus another accounting. And I think we got to keep in mind here, I mean, like Daryl said, I don't think you guys ever intended to suddenly make all these new deliverables and goods and services and arrangements. These have never been accounted for as deliverables. If we start talking about, I've heard some numbers, like one airline was like over $1 billion liability that they're going to book in transition for this, which shocked me. I don't know whether they're just taking how many times a person flies times $25 a free bag check, and this person never checks a bag, in multiplying that out. I guess the consequence of that, and we got to look at what's the users of the financial statements will see. I guess when the economy starts turning down, that $1 billion starts coming into revenue, and it masks the fact that no one's flying their airline anymore. So it's fine to be super conservative today and make all these revenue deferrals, but that's unconservative when the economy starts tanking and we start taking these reserves down and reflecting. Yeah, there'll be some disclosures, but it'll make it smooths out the bad spots, and I don't know whether that's reflective of the economics. I guess we could have a debate about that, but I just want to be careful that we're not just booking the massive liability to make sure that for everything someone might purchase in the future, and be careful and focus on the distinct part of things.
Mark, can I just chime in on one thing? And just to be fair, the AICPA Task Force on Gaming also has a paper on tier status, and they've reached different conclusions. They think they have a material right, and my guess is that's in part because the programs are different. So
they give away free. You don't have to make any purchases the next time you go in, and they give you get a free buffet.
Don't know the specifics of all of their programs. I guess my point is that the programs are different, so I don't think this is like a broad-based conclusion.
Yeah, no, I agree.
Setting loyalty programs aside, which clearly has some emotion attached to it, I just wanted to note that the notion that Mark brings forward in the paper about the key that is whether or not the discount is comparable to those given to other customers who have not entered into a prior contract, and again, setting loyalty programs aside, is, I think, very helpful to a very large group of preparers in better defining what class of customer means. I think it's going to be very dependent on facts and circumstances, so we may ultimately see what looks like diversity in practice, but in fact is not, because the facts and circumstances are different or the judgments are different. And again, setting loyalty programs aside. But I would suggest, took me to paragraph 49 where I finally sort of dawned on me in the paper. That's where it's most clearly stated. So in the meeting minutes, you might want to bring that forward a little bit.
I wonder if, as part of moving this forward, one, I think there are some concepts in the paper that will be very useful to emphasize. It doesn't sound like there's any disagreement about the fact that when you're dealing with prior purchases and accumulating something that results in receiving an item in the future without a subsequent payment. So if you want to call that a free thing or whatever you want to call that, you get that in the future without having to make a future purchase. So the miles themselves or the free hotel stay, that it seems like around the table people understand you need to evaluate those in the context of you're not in the business of giving away those items for free. And the issue seems to be when does a program that results in a discount relative to prices paid in the past, are those always, if they're based upon some tracker of past purchases, is that demonstrative of a material right? Or could that be an indicator of class of customer and when? I think the paper does some things to give you points to think about. What I hear from the table is if we leave it at that, there will likely be some level of diversity in the judgment reached. I don't know if that diversity would be to a level that's intolerable or not. But one thing that might be useful for us to think about, the industry that seems most affected in terms of the formality of the programs that are articulated in the volume, is the travel and entertainment industry, is to have some folks from the travel and entertainment and preparers from the travel and entertainment industry actually come talk to us either in small group meetings or as we did with the industry meeting on the fees we were talking, or the issue we were talking about earlier today, is bring those people in and actually understand a little bit more about the economics of the programs, the frequency at which the items are actually offered up without prior purchases. Are prior purchases a tracker for future purchases or not? And understand maybe it a little bit more at that level. See if that provides some clarity. It may not, but I would propose that as potentially a next step forward. I think we could do that relatively quickly, but it might slow down the minutes on this piece of the issue. Is that fair to say?
I think that we should be able to do that relatively quickly, but and I think it's possible we could make progress in terms of figuring out, would that level of diversity be tolerable or not? But I hope that we can all be cognizant of the fact that no matter what we do, this is going to be an area that requires significant judgment. Because even if you click the button of, okay, this is a material right, now you have what I'll call a swag to estimate the value of that. So no matter what we do, let's not lose sight of the fact that when a preparer actually has to book the entry, not that they write them anymore, but when a preparer actually has to go to book the entry, that amount is going to be a significant estimate. So there's no, I hope we can all acknowledge the fact that perfection on something like this is not achievable, so let's not let it get in the way of good progress.
Including, I would guess, in that, whether that estimate is based upon class of customer. So is the discount based upon, or just saying at that point there is no thing as a class of customer, so you got to figure the value based off of list. Could get interesting. Wes?
I would just support and echo Jim, the path that you outlined as a good next step. I do think there are important judgments in this area, and having perhaps a discussion that gets closer to understanding the nature of those judgments would be important. So from our perspective, we'd be happy to observe that and assist in any way.
So I agree with everything said. I just have a question I'll pick on Russ. I wonder if it wouldn't also be helpful to ask those that actually procure the services to come, like perhaps your travel team, to come in and talk about how they negotiate, or the large accounting firms' travel teams to come in and how they negotiate, to see if there's really a distinction between, and compare and contrast, if you've got the airline on one side and you've got the purchaser on the other side, to say, well, are you really giving something drastically different to the chairman of the not-for-profit, where we as a whole do not have the purchasing power? And I guarantee you, if I flew to Washington with anyone else from the Big Four or the government or GE today, I would probably pay twice as much as what you pay. But I probably fly more to Washington than a lot of you. But I don't have the purchasing power because I'm an individual and because we only have 15 or 18 people in this organization that fly, whereas all of you have thousands of people that fly. So I think it might be good to have the procurement guys there in the discussion.
Ian, anything from London?
No, we've got nothing to add. Thanks, Jim.
Thank you. Let's take a 10-minute break. Try to be back by 10:20. So let's go ahead and get started. The third issue is an issue dealing with scoping considerations, particularly as it relates to common transactions within the financial services, our financial institutions space. We have a couple of folks joining us. Brett Dooley is joining us from J.P. Morgan, and Dan Palamaki from Citigroup joining us. So thank you for agreeing. We thought very useful to have the perspective from people who engage in the actual transactions at a volume. that would be helpful to add to this dialogue. We also have Matt Esposito on our staff joining us, so thank you. Rob, I think you're teeing this one up as well?
Yep. Thanks, Jim. Memo 52 addresses 3 scoping questions that the staff received from the depository institutions industry. The new revenue standard includes a list of scope exceptions, and for each of the 3 income streams that are described in Memo 52, the corresponding balance sheet account is included in this list of scope exceptions: deposit liabilities, servicing right, assets and liabilities, and guarantee liabilities. The staff is aware of differing interpretations of the scoping guidance in paragraph 606-10-15-2, which has led to questions about whether the related income streams for these accounts are under the Topic 606 framework. The staff thinks that basis for conclusions paragraph 61 in the new standard is useful in understanding the board's intent with the scoping guidance. It says that if there is specific guidance to follow in those other areas of GAAP, then you would follow that other guidance rather than Topic 606. While the 3 specific questions in Memo 52 deal with transactions that are most common in the financial institution space, the staff hopes that the discussion about the application of the scoping literature will be informative to companies from all industries as they evaluate their contracts with customers. The staff has tried to lay out the thought process of how the scoping guidance in the new revenue standard interacts with each of these other GAAP topics, rather than just simply answering the scope question, as we want this to be educational. I'll provide my tee-ups one at a time for each of the 3 issues because they're 3 distinct and separate questions within Memo 52. First, question 1 in Paper 52 deals with servicing income and whether income from arrangements that fall under Topic 860 are within the scope of the new revenue model. In general, the model for servicing income that exists in subtopic 860-50, which has evolved over time, requires an entity to evaluate its expected servicing income over the term of the contract and to recognize an intangible asset or liability at fair value. And to the extent that, only to the extent that servicing income differs from the going market rate, which is referred to as adequate compensation in Topic 860. Over time, the asset or liability is diminished as the servicing income is received. The staff think that servicing income would not be in the scope of Topic 606, based on Topic 860 being present in the list of scope exceptions of the new revenue standard, and based on the recognition and subsequent measurement guidance that exists in subtopic 860-50 for servicing arrangements that are in the scope of that topic. With that, I'll turn it over to the TRG for discussion.
Yeah, Brian.
Jim, we couldn't hear any of that.
So,
yeah, I would, well, I apologize. I'd say we agree with the staff's scoping conclusion, although there's a lot of arguments in there about why the staff's conclusion is appropriate. The one argument that we wouldn't necessarily agree with is that you would get the same answer under 606 as under 860, but nevertheless, we think just a straightforward scoping argument for 860 is sufficient.
Brian, can I just ask you a question? Is it you think you would definitively get a different outcome, or it's just not so? You haven't done the analysis; it's not as clear, or sort of.
Well, under 860, you can get 2 answers, right? You can have the amortized cost method, or you can have the fair value method. So to say you would get the same answer under 606, you'd be saying, well, both those answers are appropriate. So right off
understand.
the bat.
Okay, that's helpful.
I have a harder time coming to that conclusion. I think Topic 860 first is scoped only when you have MSR assets and liabilities, and those assets and liabilities only arise to the extent that the value is greater than adequate compensation or less than adequate compensation. So it begs the question to me, what is the guidance for recognizing revenue for adequate compensation? And I understand the staff's logic that perhaps there's a linkage because what's talked about in Topic 860 is how to amortize the excess above or below adequate compensation. Clearly amortizing an asset, which is most often what's going to occur, not often will there be liabilities, is just taking a cost and amortizing it as an expense over time. That's not related to revenue recognition in the guidance. If it's a liability, perhaps there could be income related to it, but it's not frequent. But it still begs the question as to how, what that tells you, or whether there's any guidance about how to recognize revenue for adequate compensation. And I don't think that's addressed within the literature. And the staff suggests, though, that it's implied. All right? And I can understand that, but there are two paragraphs or subparagraphs that cause me greater concern with that general conclusion. Paragraph 26 says, while it's in Topic 860, we wouldn't mind if they applied Topic 606 to it. Well, it's either in 860 or it's in 606. It's not a free choice that you can do either or. I don't think that makes any sense whatsoever in the guidance going forward. But what's more bothersome to me is paragraph 27B, that when you have no asset or mortgage servicing right, asset or liability, the conclusion that Topic 860, which only applies to when you have those assets or liabilities, would tell you how to recognize revenue for adequate compensation. That makes no sense to me whatsoever. And it begs the question, therefore, if we go forward, whether we ought to have, if there is MSR assets or liabilities, one form of revenue recognition, and if we don't, another form of revenue recognition for adequate compensation. I really don't see the guidance as addressing revenue. I mean, I understand the argument that it's implied, but I don't see that being much different from the conclusions we're going to be having in the next issue on deposits and credit cards, because there's not revenue recognition guidance in those areas, even though there's accounting for the asset or liability. So I have much greater concerns, at least with extending it to paragraph 26 and 27B. But if 27B is overridden, having two different models for adequate compensation would lead me to the conclusion, at least, maybe it all ought to be in Topic 606.
Brett?
We tended to agree with the staff's analysis on this one, and that we felt like there is accounting provided for, I'll call it day two, not just day one. And I'm, maybe the experts in the room can tell me, but I've been led to believe that it would apply even if there wasn't, in other words, you'd have an asset of zero day one, but in theory you could apply that accounting, or you would apply the accounting convention. So if you elected fair value, that change could occur. And I don't know how to sort of integrate a fair value world with 606 in that context. And if you start to split it up and say, well, okay, I'm going to treat the amount above adequate comp as one thing, and then I'm going to deal with the adequate comp under 606. Now you're splitting it. I think you got all sorts of challenges around that. So taking my cue from the notion that, look, if GAAP tells me how to account for something, not just how to price it on day one, but actually how to account for it as it unwinds, then it's out of scope of 606. I do think on the point around getting the same answers, I tend to agree with Brian. And I think as we looked at this issue, and particularly if you think about performance and you're focused on performance, you might be concerned about a case where you're earning, say, a rate tied to a principal balance that's declining over time, and may or may not portray your performance. So under performance notion. So I think it could lead to different outcomes.
So I think the example that you talk about, the fair value, even if it's adequate compensation, and saying that it might be zero, asset or liability zero, but if you elected fair value, that's going to go up or down. But depending on your contract and the market. at least help me a little bit get beyond, because initially I was very much where Tom was saying, how is this really different than a business combination? You know, in a business combination, if you have an open revenue contract, you're going to record an asset or a liability to the extent that it differs from market. And I wouldn't think you would say, well, the subsequent accounting for that arrangement falls outside the scope of 606. But there you don't have, at least, you know, one difference is a similar guidance with respect to having a choice between an amortized cost or a fair value, which made me sort of feel like potentially we're provided at least a little bit more day two accounting, even if it doesn't get into an entire revenue model that talks about, well, what do you do about, you know, fixed and I guess in the fair value model maybe doesn't matter so much, but an amortized cost model doesn't go through everything that one might have in terms of a full-blown revenue thing. Caused me to sort of wonder more broadly, is it so clear that it was in scope, just personally. Jeff?
Yeah, I talked to some of our financial institutions people about this, primarily community and regional banks, and my interpretation is that they feel somewhat like Tom expressed, and in that right now they do have guidance in Topic 860, which has been used in the past and may not need to be a change for that. What they referred to is contracts for which did not have, or arrangements which did not have assets or liabilities. That would be the subservicing income. And they said that while it would have been nice to have the guidance in 606, that they could probably live with it within the topic, by analogy, 860, and there was no reason to have two areas of guidance, if you will, with respect to revenue recognition in that area.
Brett?
Jim, I agree with some of the concerns or the thoughts you had. In particular, when I look at the ongoing and the subsequent impairment guidance, even where you don't have a day one asset or liability, essentially, even without applying fair value option to it, you're essentially on a low-com model for that, which is very different, I think, than the subsequent evaluation you'd go through under either a RevRec standard or if it were just a general intangible. So my concern with scoping this into 606 is in part acknowledging that I think we'd have to go back into 860 and make some fundamental changes to the MSR guidance as it exists today. That guidance has been developed over a long, long period of time with a number of standards looking at this. So I think it is a model that has been given a lot of thought over time by the board, and I think captures the essence and the uniqueness of this MSR asset, which I think has broadly been acknowledged has a lot of characteristics of a financial instrument, even though it's not a financial instrument. And so I think keeping that model all in one place under 860 is appropriate.
Others? Yeah, Dan.
Yeah, I would echo similar thoughts. I think that both Bretts have mentioned. You look over the history. The board has done a lot of development and standard setting surrounding the servicing assets and the accounting model that's there. There's been a lot of thought and consideration given to that over time, and it covers a lot of elements surrounding that area between the standards and the EITF issues, day two accounting. The measurement that we do for servicing rights is based on looking at all of the cash flows related to what we expect from a measurement perspective. True, we do fair value accounting. We elect the fair value option for that asset and then kind of economically hedge that over time. But we really do view in part the total servicing fees that we collect over time is in part kind of collecting on that servicing right, that asset, if you will, and our financial statements and disclosures, and there's a fair amount of disclosures in this area, have a roll forward to the account, and part of what's in there is the fees that are collected, and so it's kind of viewed as, from a collection standpoint. I also think, depending on the nature of the servicing relationship, many of these relationships are cancelable at any point in time without a penalty. So there might, when you look at the duration of the contract, and this may be true with, the agencies, that if you really dig in, you might come to the conclusion that there's not a long term associated, with the servicing relationship as well. And I think some of the principles that we think about from a revenue recognition standpoint, most firms would apply today. If you think about collectability, if you're not actually collecting some of the revenue because the underlying borrower is not making payments, then you're not going to recognize that servicing revenue. And that will also have a downstream impact on your accounting for the servicing right itself and the fair valuation of it. So I think the model is there today. There's been, a lot of deliberation, a lot of careful thought about it, and I think trying to separate the accounting that we have in 860 and then separate out a component to view under 606 would be, very challenging to disentangle.
I can just add, as one board member that voted for the standard, that when I read 606.10.15-2, says an entity shall apply the guidance in this topic to all contracts with customers except the following, and then talks about contractual rights, obligations within the scope of the following topics, and then it lists 860 transfers and servicing. I just thought it was clear in my mind that these were not included in 606.
I'll just make a quick observation consistent with our prior discussion. I think this also illustrates the application, the importance of the application of the scope paragraph. So certainly the outcome of not including these in 606 is something that I think would be appropriate.
I have run up against this question sometimes in the past, and I always felt it odd that servicing was not accounted for as a revenue transaction because it felt like one to me. But I long ago came to the conclusion that people smarter than me had decided that we should look at it as a financial instrument, and okay, I think that's been the model. And I don't see that the board was intending to change that with this ASU. So, maybe when we again take a look at derecognition or some of the other aspects, somebody will decide, we really shouldn't have special treatment for servicing. But until then, I've always thought it was out.
Yeah, one observation, at least in discussing this with my financial institution friends, they indicated that in certain segments there is no compensation. So like credit card securitizations, there's no payment, so it's a mortgage servicing liability. So in that case, 860 provides 100 per, I'm not sure there would be any argument that some portion of that is in the scope of 606 based off the words that Larry mentioned. So then if you're saying, well, but if it's an asset, well, maybe some part of it is, to me that just creates a mess. So to me the question would be whether you just want to replace 860 with a more revenue recognition friendly theory or not, because there's no scenario where you can get all mortgagee servicing into 606.
Rob, you want to move on to the next issue?
Sure.
Question 2 in Memo 52, which starts with paragraph 28, deals with deposit-related fees. When a customer opens an deposit account with the bank, that deposit is accounted for as a liability under Topic 4 or 5. And Topic 4 or 5 is among the gap topics that are listed as being out of scope of the new revenue model. Unlike the servicing income in Issue 1, it was not clear to the staff what accounting framework would be used for these deposit-related fees if Topic 606 isn't applied. The staff think that in the absence of clear literature, questions may arise on the appropriate accounting for and disclosure for this type of non-interest income that banks earn from deposit relationships. The staff also think that Topic 606 can be applied in a straightforward manner to these deposit arrangements. And in the paper, we've tried to lay out a brief implementation analysis that we think will be helpful and will most likely lead to recognition outcomes that are similar to today's accounting. In other words, we think that in most cases, the application of Topic 606 to straightforward arrangements like these deposit fee arrangements should not be a complex undertaking. With that, I'll turn it over to the TRG for discussion.
This one's a little tougher in the sense that I don't think that there's clear day 2 accounting, if you will, using my day 2 example from before. But I guess taking our cue from the credit card fee, where we said, well, the credit card fees are scoped out because there's guidance that tells you how to deal with credit card fees, and therefore everything connected with the credit card fee is in fact out of scope, whether that be loyalty points, et cetera. I guess if we're saying, well, okay, here I've got a deposit liability, I've entered into a contract with a customer, that deposit liability is in fact out of scope, so therefore I presume the interest on that is also out of scope. And I think so. I guess the way I would think about this is if I've concluded that whatever these fees aren't part of my effective interest rate on the financial liability that I've got, then then the question is, well, okay, where are they? Do they get scoped into 606 because of that, or is there sort of just a black hole that and people just make reasonable assessments around? I guess we weren't, if the view of the board is, look, because they're not captured someplace else, they have to by default, they fall into through this waterfall into 606. I can understand that analysis. I'm also not sure that that would have been everyone's natural conclusion, but. I think the only thing I'd say around the staff's conclusion in the paper is I wonder whether the application might be somewhat oversimplified, and by that I mean the suggestion is that, well, these are kind of optional purchases. The customer can leave and take their money out at any time. That may be true with deposits, but for example, a CD, right, where there's termination penalties that may not be the case in all aspects of this relationship. And I also think that, if you say they're in 606, then you might have to think about things like material rights. So, for example, if you've got an arrangement with your customer where you said, look, you pay me a higher fee in year 1 and in year 2, and in exchange for that I'll give you lower fees on the same thing for years 3 and 4, is that not a material right? So saying they're in 606, is fine. I just think we should be careful not to signal that this is always going to be cash basis accounting, because I think that might be oversimplifying.
Yeah, I tend to agree with Brett here, and we didn't really have a huge issue with the conclusions that the staff reached, but there was some things in the paper that sort of suggested holding your cash or safekeeping your cash was somehow a performance obligation. I thought when the board, and I didn't go back to the meetings, but I thought the boards concluded when they were talking about performance obligations that those wouldn't be performance obligations, holding someone's cash or sending out bank statements and those type of things. So I think we're pretty much on board with the staff's conclusion here, but just want to make sure that you weren't implying somehow that The only thing that matters is that both parties can walk away at any time. I think, like Brett said, you got to deal with material rights if that's the case, and sort of implying in here that holding your cash, and I know there's some issues bubbling up in the AICPA papers around custodial, trade. I make a trade, then I hold the stock. I mean, are we suggesting that's some kind of a performance obligation that needs to be the deferral of revenue around these? And I agree with recognizing the ATM fees when they occur. I don't know whether that's through paragraph 5518. That's the value to the customer of that transaction. But I certainly didn't think it was for the follow-on custody type arrangements.
Mark, we have heard some of those other questions as well about you pay your broker to execute a trade for you, and then let's say your broker is going to actually hold the security for you. I think that's where the guidance that the board issued last week on you don't have to account for things that are immaterial, essentially, and we actually wrote that into GAAP, notwithstanding the fact that Scott Taub thinks that's stupid that we wrote down you don't have to account for immaterial things. But I think that's where that would come into play versus, let's say I have an account with Citi and I want to execute an outgoing wire transfer. There is nothing else. Right? You can't say it's immaterial in the context of the contract. The only thing I'm doing with Citi in that case is executing a wire trade. So I think we have guidance in place to deal with, we now have guidance in place to very clearly deal with the fact that if you have something that's immaterial / not really what the arrangement is about, you don't have to account for it. But here we're talking about there is nothing other than this one straightforward transaction that's occurring.
Was your concern, Mark, that it talked about account fees in that same context, and some would say that that isn't really a separate performance obligation? You may be able to charge certain, hate to use the term, classes of customer account fees and other classes not. But
yeah, I think once you go down that path, I mean, I've told you this, Jim, before. I think my first stock purchase was 25 years ago, and I still own the stock. I mean, how long are we going to defer this revenue? And is that really what I purchased? I think I think you did make it clear, Cullen, but I just want to make sure that's what we're talking about.
So fair enough, but this question, I think we should stop talking about it because I think the board's intention is very clear that you wouldn't have to do that. So I don't think that's a good example to talk about anymore.
Brett,
I agree. I think UC is a reasonable conclusion on this. I admit when we were going through over the last several months thinking about this issue, I do think that there are some aspects of a potential performance obligation that we're scoping into 606 that does overlap with an existing performance obligation that's captured in 450. But when I look at the guidance, especially the walkthrough of how you'd apply 606, I don't think that you get to a materially different answer. And so I think that trying to identify those types of performance obligations and where that overlap exists is probably more intellectual work than it's worth. And so I think for that reason, I think UC is probably a reasonable outcome here.
I just have a hard time understanding how we're communicating consistently, because I thought that we said the first issue was excluded because topic 860 is excluded. Well, so is topic 405. So either we excluding it all or we're excluding, how are we picking one differently in these two examples? I mean, it's relying on potentially BC 61. But again, I would assert that the first example, the first situation, there is not explicit revenue recognition guidance on it, even in the fair value setting. It just says measure the change in fair value and flow through income. It doesn't say what line items or what revenue. It doesn't seem we're being consistent in the conclusion.
One way I've thought about that, Tom, is at least in the first issue, I think that they're inseparable. That is, the servicing fee is inseparable from the MSR, the sort of two combined things, versus a wire transfer is not necessarily a natural outcome of having a deposit. that is something you can optionally come in and say, I would like to wire my money, and somebody says, I'll do that for you for a fee. 100 years ago, somebody would have said, well, put my money in a stagecoach and send it somewhere, because that's how I'm going to make my payment, and I'll do that for you for a fee. So that's maybe a little bit more separable from the deposit arrangement. Granted, some of the activities may be less separable, but even the ATM, you could say, I don't, in today's world, I guess, unlikely to happen, but I don't offer an ATM network. The only way you can get your money back is to come in. No, I provide you a separate service. You can get them at an ATM. You got to pay a fee. So that might not be a beautiful separation, but I think there's at least a little bit of removal of the subsequent activity from the deposit. Brett?
Yeah, I agree with that. And that's why I said if it's part of the effective interest, then I agree it's out of scope, right? So in other words, if the performance obligation being the bank deposit and the related interest on it is out of scope, but now these transactional fees that may or may not have happened with depositors could have, like the ATM fees could be charged to non-depositors too, and the wire. So there's a separability there for those types of fees that I think is, so that's how, at least in my mind, how I square the two issues.
Tom, I had the same observation as you had when I read these two, and we have a large banking practice, so we spent some time talking through this. And for a lot of the same reasons I think that Brett and Jim just alluded to, I was able to get over that hump. It's not as clear cut, but I think you can get there, and so I think we're supportive of the conclusion.
Yeah, I would also agree with the conclusions the staff reached on this issue, and it wasn't initially how I had been thinking about it, but I think the analysis makes sense to me that these additional services that get provided aren't intertwined, with the deposit liability itself. And I think coupled with the implementation guidance that's been provided, that's very helpful. I think the answers that we get to are reasonable and make sense. And we've also given this some thought relative to deposits that we get from corporate clients as well. And for us, probably half of our deposit base come from corporations. And when we look at, so it might be $400 or $500 billion of deposits in total. And when we think through kind of the implementation guidance and some of the focus there on transaction price and so forth, the conclusions that have been reached that seem to focus on a retail depositor, we'd come to a consistent view with a corporate depositor as well. So.
Okay. We'll move on to question 3 in Memo 52, which deals with fees from guarantees. Guarantees that are accounted for under Topic 460, other than product or service warranties, are listed among the scope exceptions in Topic 606. As an example of a typical guarantee under Topic 460, the guarantor agrees to pay the lender if the borrower defaults on a loan, and the guarantor collects the fee either upfront or over time. The staff thinks that fees from these types of guarantees are not in the scope of Topic 606. The staff thinks there is good reason why these fees are not in the scope of Topic 606, because the 5-step revenue model does not easily contemplate the unique stand-ready risks that arise from these guarantees, and there's already an accounting framework and subsequent measurement principles that are in place for entities to use in Topic 460. But the staff is aware that there are some places in GAAP that suggest otherwise today. For example, Topic 310 and Topic 942 both include guidance that points to Topic 606, refers to 606 when accounting for the fee income from guarantees. So to eliminate confusion and encourage consistency in the guidance and in practice, the staff plans to recommend to the board technical corrections to Topic 310 and Topics 942 to make it clear that fees that are earned from guarantees that are within the scope of Topic 460, other than product or service warranties, are not in the scope of Topic 606. With that, I'll turn it to the TRG for discussion.
Thanks. So I think we were fine with the conclusion and think that the consequential amendments are very important here. But one question, and I spoke to you about this a little bit earlier, that still remained is, so if everything's out of the scope, companies would no longer be looking to, because I think in paragraph 58 we talk about the guidance in 46010, 60-8 points to revenue guidance that's being superseded. So if that's all gone and off the table, what is the guidance that companies would be looking to recognize the guarantee income?
There are certain guarantees that are not in scope of 460 that you were not. You would look to whatever existing literature exists. 815 has some guidance. There's certain types of standby commitments, letters of credit, where there's gap for those. But we just want to clarify that the guarantees that are in the scope of 460 would not need to point to 606, and we'll be careful with the wording in the technical correction to make sure that it's clear. There's no confusion for other types of guarantees that are not in the scope of 460.
I think the day two accounting treatment in this area, I'm not aware that there's a big diversity in practice, and I think there's even an SEC speech going back a ways, Greg Fawcett, where it said really a rational and systematic approach for recognizing the revenue from a day two standpoint. So I don't think there's a lot of diversity in practice that's out there, and that would necessarily warrant additional guidance. That's just my view.
So I think on the issue as a whole, I guess I would characterize it as a relative agreement with the assessments in the staff paper. Okay. Brett, Dan, thank you for joining us. On to issue 4. Mark, I think you're
that's
covering
me.
issue 4.
Sorry. Okay, the next issue relates to how control transfers when a performance obligation is satisfied over time. Topic 606 requires an entity to evaluate whether it satisfies a performance obligation over time or at a point in time. Paragraph 606.10.25.27 states that an entity transfers control of a good or service over time and therefore satisfies a performance obligation and recognizes revenue over time if any one of 3 criteria are met. When an entity determines that a performance obligation is satisfied over time, revenue is recognized by measuring the progress towards complete satisfaction of that performance obligation. An entity is required to select a single measure of progress for each performance obligation satisfied over time that depicts the entity's performance in transferring control of goods or services promised to a customer. Some stakeholders have questioned whether an entity that satisfies a performance obligation over time can transfer control of a good or service underlying the performance obligation at discrete points in time. Said differently, some have questioned whether an entity that recognizes revenue over time can begin performing and also recognize a material asset, such as work in process, as a result of its performance. This question has been raised primarily in the context of a contract that includes a single performance obligation that is satisfied over time. The staff thinks that topic 606 is clear, that meeting any of the criteria in paragraph 606.10.25.27 implies that control does not transfer at discrete points in time. Rather, control transfers in a manner such that an appropriate measure of progress should not result in an entity recognizing a material asset such as work in process as it performs. The staff thinks that topic 606 also is clear that any asset that is created as the entity performs would be the customer's asset. So I'll turn it over to TRG for discussion.
Yeah, and this one, I mean, we agree with where the staff ended up. It was interesting, though. In our discussion, we start talking about sort of the revenue dictating whether or not you record an asset and how you recognize revenue. And it's a bit odd. I thought the standard, like you said, was pretty clear, at least in 34040, that a partially and any cost related to a partially satisfied performance obligation must be expensed as incurred. So you can't have an asset if you've transferred control to the customer. So I don't even know how you would even get an immaterial asset on the books if you're performing over time and you've partially satisfied. And so when we read that, we're like, an appropriate measure of progress should not result in a material asset. Measure of progress, we're talking about the revenue, right? We're not talking about recording an asset. So that confused us a bit, but I think we would separate the cost from recognition from the revenue recognition, and we'd say, the costs need to be expenses incurred for a partially satisfied performance obligation, which is what the standard says, and then the manner in which you recognize revenue, you have to pick the one that best depicts your performance. And I think in this fact pattern, that milestone doesn't seem to best predict it, although the standard still leaves it open for a milestone method in certain circumstances. So I don't know whether we thought about that wrong, but we thought it was pretty clear. You can't have an asset, even if it's immaterial. And so that's sort of where we are, and we thought the staff's conclusion was fine.
Yeah, I think generally agreed with the paper. Maybe a couple observations. I think in paragraph 19, and there's been a lot of talk about, units of production milestone method, probably can't do that. I guess I would temper that in the sense that, yes, as traditionally applied, probably not appropriate, but if you had a means to measure progress between the achievement of milestones, then maybe that would be an avenue. And so in paragraph 24 in the last sentence where it says you could record an immaterial asset, other than just it being immaterial to the financial statements, that would be the only basis we could see for doing that. Otherwise, you would be better off or more consistent with the principle of the standard to come up with some way to recognize revenue for the progress you've made between milestone achievements, assuming a milestone method's appropriate in the first place.
So is that partially at least the same point as Mark in terms of the asset is cost expenses incurred? You may end up with entities that, as a practical matter, have immaterial things. GAAP doesn't tell you what to do with that immaterial thing, but being clear that you ought to expense costs as incurred, knowing that people can develop expedients or other things that are in conformity with GAAP in all material respects.
But normally, Jim, any suggestion I agree with Mark would just I would
sorry, I didn't mean to characterize it that way.
But, Brian, we should go to lunch and work this out.
Brett,
you won't be able to pick a restaurant.
We can hug it out after the meeting. But yes, in this case, so
yeah, as hard as it is, I too agree with Mark. I do, and I think the staff's analysis in this paper is spot on. I frankly think that BC 165 seems to more or less directly address this question. My assessment talks about a contract manufacturer and even tells you how to go about evaluating whether the WIP is material. It points to having a period end WIP and sort of suggests that you could, as long as it's immaterial, that's fine. So. Taking our cue from that, we thought the analysis was correct. That if you're in over time by virtue of this sort of the paragraph C analysis of no alternative use, and you're transferring control as you go, then it only follows that you shouldn't have any material WIP on your balance sheet. The only thing I'd point out is that we talk about WIP as if we all know we're talking about the same thing, and I think some people. If WIP is sort of, look, I've got these standard parts that I'm beginning to assemble, they could be directed to anybody. They haven't been committed to this particular contract yet, and I'm calling that WIP. That may not be a problem. On the other hand, if I'm beginning to assemble the customer's widget, and it has no alternative use, and the concept is the customer owns it, then it just follows that you should have it on your balance sheet. So.
Brett just made the point I was going to make, and maybe I'll elaborate on it a little bit because we have a lot of overtime contracts where we're building customized equipment for customers, and we thought a lot about this question because we started analyzing it initially, and we had one of our major product lines, gas turbines, for example. We started looking at that fact pattern, and we realized that up to the last part. So you basically think about a power plant that you're putting a gas turbine into, and you've got to go and install it, and you've got all the ancillary things that go with the gas turbine to connect it to the grid. So it's a major project. Seems like it's kind of an overtime accounting model. But when we started looking at it, we realized we didn't have rights to payment during the early part of the manufacturing process, and we started to really dig into and understand why is that. And as it turns out, the standard unit, or the gas turbine itself, is somewhat standard, and it's basically, we started thinking about it in terms of it being really just inventory. It could be redeployed to another customer. We started understanding why is it that we're not getting rights to payment for the work that we're doing, and as it turns out, we wouldn't give them access or control of the asset if they terminated the contract at that point anyway. So the expectation is we would just redeploy it. So why would we ask them to pay for it? So we started to really analyze it and realize that just because we don't build these into inventory and put them on a shelf, they're pretty big and expensive, shouldn't change the accounting, because that could be the business model. You could build these in theory, put them on a shelf, and the question we asked ourselves is, would we recognize revenue when we just signed a contract because we've got these sitting in inventory? The answer is no. So we thought that performance in the contract in that context really starts when we start to customize the unit beyond the point that it could be redeployed easily. So we kind of call that the point of no return. The discrete point in time notion kind of scared some of our controllers because we've gone down this path, and then I clarified to them, no, we've got to make sure we understand the difference between WIP and inventory. And we think of WIP as being sort of progress on the contract. And we've gotten the contract, and we're starting to produce. We are starting to build and produce under this contract, but at some point, it's really just inventory. It's point in time inventory, but that shouldn't change the conclusion. So that's something that maybe if the staff agrees, I think it would be helpful to clarify in the minutes, because when we sent this out to our business controllers, that's what they came back with. The concern is, well, wait a minute, what do we do with this basically inventory? Is that the same thing as WIP, because we're doing it for a specific contract?
Yeah, and Russell, you're spot on. So in your example, the performance obligation that we'd be referring to with this issue would be the customization, because I would imagine that you probably wouldn't meet the overtime criteria for making that stock turbine in your case. So what we are referring to is the customization. So once you begin that customization, you begin recognizing revenue. At that point, you shouldn't have WIP or any asset on your books.
That's the way we were thinking about it.
Anyone else? Good. So I think another one where I think we can summarize in the minutes effectively what's in the staff paper. We can figure out, Russell, if we can make something just to make that. I think people agree that's the outcome. It seems like the right outcome. But if people are skipping through that because of the words in the staff paper, I think we can figure out a way to make that a little clearer. Issue 5, contract asset treatment when there is a.
Jim,
I'm sorry, Ian. Yes, anything I should have asked. Anything in London?
Could we just say that we found the discussion helpful, and the clarity that was put around it is useful. Thanks.
Thank you. Who's teeing up issue 5?
Me.
Oh, okay.
Okay, we'll turn to Memo 51, which deals with the accounting for contract assets when a contract modification occurs. It specifically talks about situations where the modification is treated as if it were a termination of the existing contract and the creation of a new contract. This type of modification falls under paragraph 606-10-25-13A of the new standard, where the remaining goods or services after the modification are distinct from the goods or services transferred prior to the modification. And the additional goods or services that arise from the modification are not at their standalone selling price. The question raised to the staff is, what do you do with the contract asset when you're applying that modification guidance in paragraph 13A? The use of the word termination in paragraph 13A has led some stakeholders to question whether the contract asset should be written off at the modification date. There were two views raised, and the staff think that view B in our paper is the correct application of the new revenue guidance, and it results in prospective accounting, which is what the board intended for in these situations. The staff think that the important takeaway from the Memo 51 is how the formula works in paragraph 13A1 and 13A2. That formula provides guidance on how to allocate consideration to the remaining performance obligations after the modification, and it may result in there being no adjustments to a contract asset or a liability. In other words, paragraph 13A does not require a contract asset or a liability to be written off. It merely calculates the amount of the transaction price to be recognized prospectively. The paper discusses one particular fact pattern, but there could be other variations of this example. For instance, the modification could call for changes in pricing during the existing one-year period rather than just the extended contract period, as in our example. The staff would like to point out that there is additional guidance that may need to be considered in more complex fact patterns. For example, paragraph 606-10-32-45 addresses changes in the transaction price after a modification and describes certain conditions that would require an allocation to performance obligations that have previously been transferred. We encourage stakeholders to think about the formula in the standard and the outcomes, keeping in mind that when you fall into paragraph 13A of the modification guidance, you essentially want to avoid the double recognition of revenue. Different facts and circumstances in a modification can impact the accounting. We understand that practice is moving from a place where today there is no guidance on modifications for most industries, moving to a new overarching modification model in GAAP. But this will not eliminate the need to apply judgment. There are many variations of contract modifications, and they can be very complex. Sometimes can be a judgment call about the substance of what's occurring in a modification, which is no different than today. Determining the correct type of modification, whether you are in paragraph 12 or paragraph 13A, B, or C of the modification guidance, will be critical to achieve the proper accounting treatment. Colin, I believe you had some remarks?
Actually, let's stick with this, and I'll mention that at the end.
Okay. Great. I'll open it up to the TRG.
Allison?
I was going to say that we agree with the analysis in the staff paper. I know that there had been some questions with a couple of industry groups. Because the standard wasn't clear, there was some debate about this issue, so I think it's helpful to have it clarified that you should not write off the contract asset. I think that seems to be fairly definitive, and so there wouldn't be an alternative view that would be acceptable under the standard, so that's helpful.
We too agree with the staff's analysis. It makes eminent sense. It's sort of intuitive. I think the follow-on reminders are helpful. I think because not all modifications are created equal, and in this case, I'm adding additional years or whatever of service. So it makes sense to me, and you wouldn't have some sort of a write-off and then more revenue in the future. We agree with it.
Yeah. So for what it's worth, we've been accounting for modifications for years because we have a lot of them, and so we developed a framework because it felt like we were recreating the wheel every time an issue came up. So we created a framework about 5 or 6 years ago, and the concepts actually are pretty similar to what you have in the standard, and the words are different, but the concepts are the same. but as it relates to what you do with a contract asset, this is how we think about it. So, you know, it was a bit of a wiping the sweat off the brow when we heard this question came up. But we, you know, we think it makes sense because if you think about it, while the activities that you've done in the past may be distinct from the activities that you're going to do in the future in the modified contract, the economics are always contemplated. In other words, if you've recognized revenue ahead of being paid for it, that's going to be something that's factored into your negotiations of the future contract. So that makes complete sense. I totally agree, though, that the iterations of this are just you can't imagine the type. I mean, and they never come just as simple as a price change. It's always a price change along with scope and extension. You name it. So they're very complicated. You know, to have a one size fits all kind of framework is almost impossible. You could almost have a separate TRG for modifications. I mean, if you're not careful, I think. You know, for example, the point you made, I can take one change to the fact pattern that you had where you actually lower the price, not just for the extension period, but for the remaining term of the existing contract. Our framework would say you would take a small impairment or an impairment to the asset before you carry it over. People may have different views on that. That's just, you know, and maybe that's okay because I'm pretty sure that we have different views on nuances to that accounting today. So my only point is that this is, I'm glad the topic came up broadly, but I think getting into a lot of detailed guidance is going to be a challenge.
I think that's part of Rob's sort of reminder at the outset. We're going from GAAP where, so depending on the nature of the transaction, maybe an entirely wide open field with no contract modification guidance to more comprehensive model that gives you the framework. That doesn't mean there won't be difficult questions within that framework if I'm in this paragraph or that paragraph, or what do I do when I have, as you suggest, you know, scope, price, quantity, and, you know, some other thing going on of figuring out fact specific how to apply that framework. But hopeful that at a minimum gets us all on the same playing field where we didn't have that in the past. Brian?
Yeah, I think we agree with the notion that the standard, whether it's through this modification guidance or variable consideration or other aspects of the standard, drives one towards an answer of not recycling revenue. And so we would agree with, you know, the simple facts that are in this paper that the conclusion is appropriate. We do think, you know, a condition precedent to getting to that answer is that you did the accounting on the first contract correctly. So that means you considered whether there was a material right, whether the term, what is the term of the contract, whether there was any variable consideration. But assuming you got that all correct, then this would be the place you would find yourself.
I can put my tent down real quick because I was going to say the exact same thing, and I completely agree with Brian.
Have some ice cream.
With sprinkles.
I too would agree with the staff's views in this paper. As many of you know, this is quite an issue in the telecom industry, and I suspect you don't want to hear about telecom. But and I do think this example is not particularly going to help with a lot of that debate because we're driven specifically into modification account by virtue of modification accounting by virtue of the new transaction price, and you don't have to talk about collectability of the contract asset. So I think many of the debates will continue. And someone else mentioned that facts and circumstances can change the answer, and I think that is particularly true in the industry that I'm involved in.
I just wanted to point out that there is an example in the paper. I'm sorry, not in the paper, but in the standard example 7 on modifications of a service contract where the remaining period, the price actually was adjusted down, and it was all prospective. So there was no retroactive adjustment. So I think that the formula would work similar there, as long as you don't have like the variable consideration that needs to be allocated to the past, and your contract asset or liability then as well wouldn't be adjusted. So I think that's another helpful example there.
Ian, any comments or observations in London?
No, Jim, we're quite happy with that conversation.
One other item the staff wanted to mention, which is not directly related to this issue, but there is an example in this paper that we hope will help practice to some degree. Mary and I received a technical inquiry from a large preparer group about when an item should be presented as a receivable versus a contract asset. So it's not about when you recognize revenue, it's not about net income, it's not about whether you have an asset or not, it's solely do you present an item as a receivable or a contract asset. And the staff thinks the core guidance in the standard is clear in terms of when you have a receivable. It's the right to consideration that's unconditional, and then it goes on to say, it's unconditional if there's only the passage of time between you and that consideration. So we think that that's clear. However, the preparer group that raised this issue observed that in example 38B, the very last sentence of that example has a statement that they think confuses the analysis a bit, and at least Mary and I agree with them that it confuses the analysis a little bit. And so when we have our next round of technical corrections, the staff plans to recommend to the board, they can do what they like, but we'll at least recommend to the board that we'll try to clarify what that sentence is trying to get at. But in any event, we don't think it subverts the guidance, the core guidance in the standard, which explains when you would have a receivable versus a contract asset. This preparer group that reached out to us with this specific question, they also observed that there are other questions out there in terms of when an item should be presented as a receivable. And they observe there's cases today where there's certain fact patterns where there's some diversity in practice. And their view was that the new revenue standard didn't necessarily resolve that diversity, that it would be, a facts and circumstances judgment. So one example they gave us was a fact pattern where, let's say you have two separate legal contracts, but for accounting purposes, those contracts get combined and you account for it as if there were one contract. If you combined it tomorrow, you're very likely to combine that under the new revenue standard as well. And the point that they raised was it's not unusual in practice today for some companies to do their receivable accounting on each of those separate legal contracts. And then there's some cases where the receivable accounting is done at the combined accounting level. The staff's view is that the standard didn't resolve that specific issue. There's an area where there's diversity today, and I'm not sure that would be definitively resolved under the new revenue standard. Another fact pattern that was brought up to us was a circumstance in which you have a performance obligation that is satisfied over time, and the question is, do you build up the receivable each and every hour or each and every day as you recognize revenue, or are there other approaches that are acceptable? Today there's diversity on how folks think about this, and at least the staff's view is that the new standard doesn't definitively resolve that question.
And your point is, all in the context of this doesn't impact revenue recognition. It's presentation of an asset between receivable and contract asset.
Right, and not even recognition of an asset, just where you present it.
So I think on the fourth issue too, and just to summarize, I think the minutes or the summary would reflect the thinking in the staff paper, and I think couple suggestions around the table. Another issue that I think we can say is at least address the question in practice. I think that closes the end of the open session. We wanted to have just a short administrative discussion. Folks in London, thanks for joining us. I think you're welcome to to stay for that piece as well?
I think, Henry, you mentioned you would be willing to stick around for a few more minutes.
Yes, I think that'd be appreciated.
Maybe if you just give us 5 minutes and we can reconvene at just past 11:30.